Focus Online College. Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 0719451155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 0719451155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 0719451155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 0719451155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 0719451155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 0719451155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 0719451155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 0719451155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 0719451155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 0719451155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 0719451155. Focus Online College, bringing the classroom to your home. September 2025 intake now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake, now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake, now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake, now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake, now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake, now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake, now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake, now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake, now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake, now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake, now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155. Focus Online College, bringing the classroom to your home. September 2025 intake, now open. Take charge of your future with Focus Online College. Enroll now for the September to November 2025 semester and study CPA, CIFA, ATD, CAMS, CS, and BDA from the comfort of your home. All for just 4,500 shillings. Classes begin on the 1st of September 2025. Why choose Focus Online College? Expert tutors with proven track records. Live Zoom classes, plus access to class recordings. Flexible study, anytime, anywhere. Call or WhatsApp us today on 07194511155.
must we start with the topic 1. So we will be doing those particular topics randomly, but what is important is that by the end of the day, we finish what? We finish the syllabus. Now, I want us to go straight to this, and maybe the first thing we need to ask ourselves here is basically what is a professional firm? What is a professional firm? So when we talk about a professional firm, basically, this refers to those particular firms which are established by experts in certain fields, basically to provide professional services to their clients. Now, a good example of a professional firm is something like an accounting firm, something like an auditing firm. Maybe once you complete your course, you become a CPA, you may decide to start an accounting firm. You may decide to start an auditing firm whereby you'll be providing various accounting services, various maybe services like taxation services, auditing services to your what? To your clients. So another good example of a professional firm is like a law firm, something like maybe like even a clinic. If, for example, maybe you're qualified as a doctor, you may decide to do what? To start maybe a private clinic. That is still a professional what? Firm. So therefore, these particular professional firms, we have said essentially they provide professional services to their who? To their client. And therefore, being the owner of a professional firm, at the end of the year, you must evaluate, you must do what? Assess the performance of your business, because this, despite being a profession, this is a business. So you must be able to, well, you must evaluate the performance of your business. You must determine whether your business operated at a profit or a loss. And also you must evaluate the financial position of your what? Of your business. So therefore, at the end of each year, the professional firms are expected, or basically the professional firms basically prepare the financial what? Statement. So remember, financial statement, these are basically the final accounts. The final accounts which are prepared by business entities, including the professional firms. Number one, to ascertain the financial performance of that business. If you want to know how your business performed, whether your business operated at a profit or at a loss, you have to prepare final accounts or the financial statement. Number two, these particular final accounts or these financial statements are also prepared to ascertain the financial position, of the business. When we talk about ascertaining the financial position of the business, this basically entails evaluating the assets, or basically determining the assets, determining the liabilities, and also determining the capital of the business at the end of the year. Remember, here we have said a statement of this, or basically we evaluate the performance of a business in terms of determining whether a business operated at a profit or at a loss. So in this case, we have said that all businesses, including professional firms, at the end of the year, they must prepare financial statement, which is saying a final account. Those accounts which are prepared once the year comes to an end to do what? To evaluate the performance of the business. And actually, we evaluate the performance of the business by determining whether a business operated at a profit or at a loss. And actually, we do that by comparing the incomes and also the expenses. So we also prepare this financial statement to ascertain the financial position of what? Of the business. And actually, we do that by preparing something called the statement of financial position, what was formerly known as what? The balance sheet. Now, the main objective, therefore, of this particular topic, the main objective of this particular topic here is basically to help you in terms of knowing how we prepare the financial statement of various professional firms. But before we look on those particular financial statements which are prepared by various professional firms, I want us to basically define various terms. We look on definition of various terms, definition of various terms. Basically, we will come across in this particular topic here. We look on definition of various terms. So the first term, maybe you can start by defining here, is the term a profession. Is the term what? A profession. But even before you look on the definition of this particular term profession, remember I've said that a profession basically, a profession is something like what? Like auditing, like accounting, like maybe what? Like maybe you are a surveyor. That is, we can say is a good example of what? Is a good example of a profession. So in this case, when we talk about a profession, we say that this is a specialized field, or is a recognized specialized field of study, which involves some training and basically some examination, which is administered by a certain examination body. So it is basically a recognized what? A recognized field of study, a field of what? Of study, which involves some training, and basically examinations, or basically it involves some training and also some what? And also some examination, which is basically administered by a certain examination body. For example, for you to become an accountant, for you to become an auditor, you must go through some training. That's why, for example, you're doing a course called CPA. And other than going through the training which we offer you, so you must, by the end of the day, sift for some examinations which are administered by CASNET, and you pass those particular examinations. So once you have passed all the CPA examinations, that's when you become an accountant. That's when you become an audit. That's why we are saying a profession is that particular recognized field of what? Of a study involving some training and also examination, which is basically administered by a certain examination body like CASNEB, like NEC, and so on. So the other term we also need to define here is something called the work in progress. The work in progress. The work in progress. So when we talk about the work in progress, abbreviated as WIP, this refers to that work which a professional firm is undertaking on behalf of the client, but that work has not been completed at the end of the year. Assuming, for example, maybe you have an auditing firm, so you may be undertaking some work on behalf of your client, but when this is coming to an end, you have not completed that work. You have not completed that work. So we refer to that as work in progress. It is working in progress. In law firm, we refer to this as cases in progress. Cases in what? In progress. Cases in progress. These are those particular cases, maybe which are instituted by a law firm, in a court of law on behalf of their client. But when the year is coming to an end, those cases have not been concluded. The judgment, the ruling in relation to those particular cases have not been delivered. They are cases in progress. They are cases in what? In progress. The other term we also need to define here is something called the disbursement. Disbursement on client behalf. Disbursement on client behalf. So when we talk about the disbursement on client behalf, this refers to any payment which a professional firm has paid on behalf of the client. For example, assuming you have an auditing firm or maybe an accounting firm, you can pay tax to KRA, you can pay tax to the government on behalf of your client, and basically you expect your client will come back and refund the amount of money you paid on his or her behalf. Maybe you paid a tax, maybe a tax like VAT, which is payable on monthly basis of, for example, 100,000 on behalf of your client. Maybe your client had not sent this particular amount of money to you, but you decided to pay that amount on behalf of your client, expecting that the client will be able to do what? To give you a refund, to refund you this particular amount of money. So therefore, any payment which a professional firm has made on behalf of the client, made on client behalf, this one is a disbursement on a client behalf. Now, when preparing the financial statements of a professional firm, this one is usually accounted for as an asset. This one is usually accounted for as what? As an asset. Because assuming, for example, I've made a payment on your behalf, I'm assuming you have a business and maybe I've paid some tax on your behalf to to KRA, I expect you to give me an equivalent amount. So that payment which I've made on your behalf to me is an asset. I'm expecting that you give me an equivalent what amount. So this one is basically what an asset in a professional firm. There is something also I've forgotten to mention here. This work in progress, which you have said is the work which is already started on behalf of the client, but when the year is coming to an end, that work has not been completed. And therefore, because the work has not completed, it's obvious that your client has not paid you. In most of the cases, the client will pay you once you have completed the work. So therefore, this work in progress, number one, this one is usually an asset in a professional firm because if, for example, I've done some work on your behalf, but you have not paid me, to me, I should account for that as an asset. You owe me some amount of money. I should account for that as what? As an asset. Number two, we also account for this as an accrued income. Accrued income. What is an accrued income? Accrued income basically is an income for services you have provided, but you have not been paid. You have not been paid. You have provided services to your client, but because you have not fully completed the work, you have not requested your client to pay. You have not requested your client to do what? To pay. So therefore, one, this work in progress is a current asset, and number two is basically an accrued income. Is an accrued what? Is an accrued income. So that is basically the other term we need to define here. The other one, the other term which we can define is something called number four. Number four, we have something called office account, and I think I'll define this together with something called the client account. The client account. The client account. Now, generally, if, for example, you have a professional firm, you should basically operate two bank accounts. One of the bank account is whereby you deposit money belonging to your professional firm, but the other account is whereby you deposit money belonging to your client. If, for example, like you have something like a law firm, you are a qualified lawyer, you have a law firm, so you may be receiving money on behalf of your client. Do you need to mix that with your money? No. So you need to have a separate account. So you need to have an office account where you deposit money belonging to your firm, and also you need to have something called the current account. In the current account, you deposit money belonging to your client. So therefore, this money which is basically held in the current account, this money belongs to who? This money belongs to your clients. But basically, you hold it, or you're in possession of this amount of money. So in most of the cases, when preparing the financial statement, number one, this is accounted for as an asset. You'll be able to see that because you hold this money. It is in your possession. Basically account for that as an asset. And by the end of the day, because this money you have to remit it to your client, you also account for that as what? As a liability. As what? As a liability. So I think these are basically some of the terms you need to understand even before we move and basically look on how we prepare what? We prepare something called, we look on how we prepare the financial statement. We look on how we prepare the financial statement. So let's now move and look on the financial statements, which are basically prepared by the professional firms. The financial statements which are prepared by the professional firms. And remember what we have said here. A professional firm is just like any other business. If, for example, maybe you are a doctor of a certain field, you are a dentist, you may decide to open your own clinic. So that is a business you are doing. So by the end of the day, you must prepare financial statements to know how your business is doing, how your business is performing, and also to know the financial position of your business. On the other hand, we have seen you must prepare a balance sheet or a statement of financial position to know the financial position of your business, the assets which are there in your business, the liabilities, and also the amount of money which you have invested. So therefore, professional firms, just like any other business, prepare financial statements. Which are the financial statements prepared by the professional firms? They include number one, income statement. This one is also called the statement of profit or loss. The statement of profit or loss. Maybe for those who have done degree, you may have come across something called the trading profit and loss account. Currently, do you use that name? No, we don't use the word trading profit and loss account. We use the income statement or the statement of profit or loss. Number two, we have the statement of financial position. A statement of financial position. Statement of financial position, this what formerly was known as the balance sheet. Do we currently use the word balance sheet? No. Currently, we don't use the word balance sheet. We talk of the statement of financial position. Now, an income statement, or basically a statement of profit or loss, a statement of profit or loss. This one is prepared to ascertain the financial performance, of a business or basically of a professional firm. So this is prepared to do what? To ascertain the financial performance. So you ascertain financial performance basically by determining whether a professional firm operated at a profit or at a loss. How do we determine this profit or loss? So for you to determine the profit or loss of a business, you compare the incomes, or in other terms, you take the incomes of the business minus the expenses. Minus what? The expenses. So the difference here is a profit or loss. If the incomes are more than expenses, that is a profit. If expenses are more than incomes, that is a loss. That is what? That is a loss. That is a loss. Now, how do we prepare? This income statement or the statement of profit or loss? And even before you look on that format, it is important for you to note that a professional firm here, we have said, basically provides services to who? To clients. So once a professional firm, maybe like a law firm, provides services to the client, provide professional services to this client, so the professional firm here will charge a fee. So here we talk of the fees which has been charged. So the fees which has been charged is one source of income. Is actually the main source of income to the professional firm. The fees charged. We also have something called what? Or we can also refer to this as the cost charged. Why do we refer to this as the cost charged? Is because if, for example, you have like a professional firm, and you are providing services to your client, like you have an audit firm, an accounting firm, you are providing services to your client, you incur some cost in cost of providing those services. So the cost you're incurring, you charge it to your client. You tell your client, we incurred a cost of 200,000. Can you pay us an equivalent amount? So you have incurred a cost of 200,000, but you charge that to your client. So this fees charged can also be known as the cost charged. And this is the main source of income as far as these professional firms are concerned. So I want us to look on the format of preparing this income statement or the statement of profit or loss. And I hope you're together up to that point. Are we together up to that point, Doris? Are we together up to that point, Edith? Are we together up to that point, Felix? Evans, are we together up to that point? Stephen, Zindo, are we together up to that point? Are we together up to that point? I hope you're together up to that point. I hope my Morimu's sound is clear. I hope Morimu's video is clear from your side. I hope no problem up to that point. Okay, so how do we prepare this particular income statement? So in preparation of the income statement, generally, I've said we compare incomes with the expenses. Obviously, we start by recording incomes minus what? The expenses. Now, the format we use in preparing this, we refer to it as what? The vertical format. Vertical format, we don't use a T. We don't use the TF format, but we use a vertical format. In a vertical format, we have two columns here, and we always start with the incomes. So the first income which we start with in a professional firm is the fees or the cost charged. So in an exam, you can be given the fees or the cost charged. That is one and the same thing. And in this case, in some questions, you can be given, for example, a question of a law firm. A law firm. So we know if you go to a law firm provides so many services. So like we have conveyance services. Conveyance services, if today you buy a piece of land, you want that land to be transferred in your name, usually go to your lawyer. He will charge you a fee. So you may be given something like the fees charge in relation to the conveyance services. In relation to the conveyance what? Services. If, for example, you have maybe a criminal case, you're involved in a criminal case, and maybe you need to be represented in a court of law by your lawyer, he will charge you a fee. So you can be given the money which was collected by the lawyer from the criminal what? Cases. You can also be given money collected by a law firm from the civil what? Cases. You can be given the fees or the court charge in relation to the various what? Services. Yes. So if you're given that, come and include all that here. And then to this, you come here and you add something called the work in progress, the work in progress, the work in progress, balance carried down. So balance carried down, this is at the end of the year. Balance carried down is at the end of the year. But first of all, recall, what is work in progress? Work in progress, what we have also referred to as the cases in progress in relation to the law firms. We have said this is the work which is already started on behalf of our client, but because the work was not yet completed at the end of the year, the client had not paid for that work. But because part of the work was done during the current year and it was not yet paid, what you do, you come and you add this amount, the value for that work, or basically the amount of money which the client should pay you for that work, you add it to the amount you have already received during the current year. That is the work you have done during the current year, but because you have not fully completed that work, your client had not paid for it. But because it's the work which was done during the current year, add that here. It is important to note that whenever you're preparing this income statement, you prepare this on something called the accrual concept. The accrual or matching concept. So the accrual or matching concept is basically an accounting principle which requires that whenever you're computing the profit or loss of a certain year, you take incomes of that year. Not the money which you have received, but incomes for that year. If you have provided services but you have not paid for them, that is money we generated that year. Yes. So what we consider here is not money which was received, but the money which was supposed to be, or the income which was supposed to be received during the current what? Yeah. That's why you can see if you have worked for your client, but you have not completed their work, they have not paid you, that is what you did during the current year. You earned that income during the current year. So add that income there, although it was not yet received. And then to this, you less the work in progress, balance brought down. Balance brought down, this is at the start. So this is the work which you had done for your clients in the previous year. But because when the previous year was coming to an end, you had not completed that work, your client had not paid you. Automatically, you completed that work during the current year. And you are paid during the current year. But that work, most of that work you did it in the previous year. So therefore, because this work was paid during the current year, that money is included here. Does it belong to the current year? No, it's related to the previous year. That's why we are saying let's it fair. But no need of even cramming all that. So just know that here we add the closing work in progress with less the opening work in progress. And then we get something called the net cost or the fees charged. And then to this, in case a professional firm has got any other income, we come and we add it here. We add other incomes, like maybe investment income. Investment income. You may be told that a professional firm has invested, for example, in shares, it is earning some dividends and so on. We get what? We get the total incomes. We get the total incomes. After getting the total incomes, basically we proceed and we do what? We proceed and we less the expenses. We proceed and we less the expenses. We proceed and we less the expenses. So the expenses, these are the normal expenses. Things like maybe the salary to staff. The salary to who? To staff. To staff. And basically the expenses, we record them in the first column here. I hope you can see we have two columns, this one and this one. We record the expenses in the first column. We also have the depreciation on assets. So I hope you can be able to remember what is depreciation from what you did in financial accounting. Depreciation, this is the estimated loss of money value of assets. So if you buy a car today, that car tends to lose some value. So at the end of the year, you have to estimate the value your car has lost. So depreciation is the estimated loss of money value of what? Asset. So we also have things like maybe the rent and lease, rent and what? And lease. Maybe if still you have an office, you pay electricity and water. Electricity and water. Also, you may be buying some stationeries to be used in your office. You also maybe incur some telephone expenses. You also may be for internet. You pay for internet, etc. etc. These are good examples of what? Of expenses which are incurred by a professional firm. So we get the total expenses here. We take them to the last column. And basically we deduct that from the total incomes here. We deduct that from the total incomes. So what do we get here? We get the profit or the loss forward for the year. If you get a positive figure, meaning that the incomes are more than expenses, that is a profit. But if you get a negative figure, meaning that the expenses are more than incomes, that is basically what? That is a loss. That is a loss. That is a loss for the year. That is a loss for the year. That is a loss for the year. So that's essentially how we prepare what is known as the income statement, is also known as the statement of profit or loss. I think the only area which you just need to remember is here. Once you take the fees or the cost charged, you have to add the crossing work in progress, because I've said balance carried down. This is a crossing. The crossing work in progress, and then you add that one, that is, and then you less the opening work in progress. So this is opening. Opening work in what? In progress. You get the net fees or the cost charge, you add other incomes, then you proceed and you less the expenses. You less what? The expenses. Now, after that, we proceed and basically prepare the statement of financial position. The statement of financial position, formerly known as the balance sheet. Statement of financial position. Statement of financial position. Now, a statement of financial position, this one is prepared to ascertain the financial position. This one is prepared to do what? To ascertain the financial position of a business entity. Of a business what? Entity. So when talk about ascertaining the financial position, we prepare this basically to do what? To ascertain the value of the asset owned by the business, to ascertain or basically to know the liabilities of the business. Liabilities is what the business or a professional firm should pay. Maybe if it has taken a loan from the bank, if it owes the supplier certain amount of money, what should be paid to the bank, which should be paid to the supplier. Those are liabilities. And also the capital. The capital is the money invested by the owner. Now, this one is prepared based on the accounting equation. Prepared based on accounting equation. I hope equally you can be able to remember the accounting equation. Who can be able to remember the accounting equation? What does the accounting equation state? Who can be able to remind us here? Accounting equation. 𝐍𝐿. Felix. Evans. Stephen, what does the accounting equation state? The accounting equation. This is something you did in financial accounting. In financial accounting, what does the accounting equation state? Accounting equation. Yes, the accounting equation states that assets are equal to capital plus what? plus liabilities. Assets are equal to capital plus what? Plus liabilities are equal to capital plus what? Plus liabilities. So therefore, we prepare this based on that what? That equation. That equation. And I hope you can be able to recall that assets, this refers to the resources which are controlled by the business entity, and they are expected to generate or basically to earn some commercial returns. Liabilities are financial obligations of the business. And basically capital is the amount invested by the owner. So how do we prepare this one? Statement of financial position. Statement of financial position. How do we prepare this one? How do we prepare this? So we prepare this basically by recording assets. We start by recording assets. So here, we classify the asset into two. We have the non-current assets. Now, the non-current assets, these are those assets, number one, which are acquired to help the business in terms of generating income. Any asset which you acquire in order to, or basically to help your business to generate income is basically what? Is basically a non-current asset. For example, if you have an audit firm or basically an accounting firm, there is no way, or if, for example, you have an office, you must acquire some furniture. You must acquire some furniture. You may even decide to acquire a personal car to be able to, maybe whenever you want to visit your clients, it will become a little bit simple and more convenient. So that car which you have acquired, those furniture which you have acquired, they are to help your business to generate income. They are non-current assets. And number two, these assets are expected to be used for a period exceeding 1 year. So they include furniture and fittings. They also include maybe motor vehicles. They also include what? Computers, etc. So then from there we have the current assets. Current assets, these are those particular assets related to the trading activities of the business. Good examples of the current asset include one, the disbursement on client behalf. Remember, when we talk about disbursement on client behalf, we have said that this is any payment you have made on behalf of your client is basically a current asset. So we also have cash, or basically you can talk of the bank balance. And in this case, remember, you have said that if you have a professional firm, you usually need to have two bank accounts: the office account, and also the client account. So first of all, you recognize this as asset because this money which is in your possession. So we also have receivables. Receivables is the amount of money which you are demanding from your client. You have maybe rendered some services on behalf of your client, or maybe other parties owe you certain amount of money. So that is receivable. And then here we also record the closing work in progress. Closing work in progress, recall, we have said that this refers to the work which you have done on behalf of your client, but because the work was not yet completed when the year was coming to an end, your client had not paid for that work. Is a current asset. Then from there, we basically proceed and we get what? We get the total assets. We proceed and we get the total what? We get the total asset. The total asset like that. So we basically double underline turn because that is the end of the first part. So here we start. I hope you can see in our accounting equation, we start by getting assets. So once you have gotten the total asset at the right turn, then you proceed and record capital here. Capital. So this capital we usually adjust it with the number of items. One, we less something called drawings. What do you mean by drawings? Drawings refers to any amount of money which you can take from your business for your personal use. If you have a professional farm, you go to your farm, you take some cash for your personal use, that is drawings. That reduces your capital. So then to this, we add or minus the profit or the loss. So the profit should be added, whereas the loss for the year, this one should be deducted. So the profit we add it, the loss we do what? We less. So, and then we get the net capital. We get the net capital. After getting the net capital, we proceed and record liabilities. So for the liabilities, usually we have two types of liabilities: the non-current liabilities, liabilities payable for a period exceeding 1 year, and current liabilities, liabilities payable within 1 year. So we start by recording non-current liabilities. Non-current liabilities, and this can only take the form of a bank loan. The form of a bank loan. The form of a bank loan. If the professional firm had taken a loan from the bank, is an non-current liability. And then finally we record what? The current liabilities. The current liabilities. So for the current liabilities, this may include one, money held on client behalf, money held on client behalf, money held on client behalf. Number two, we also have payables. Payables, this refers to the money which is owed to the suppliers, money which is owed to the suppliers. And maybe, yes, I think those are good examples. Those are good examples of current liabilities. And then we get the total capital and liabilities. Total capital and liabilities. So whatever you get here, the total capital and liabilities has to be equal to the total assets. Has to be equal to the total asset, because we prepare this based on the accounting equation, which states that assets must be equal to capital and liabilities. Must be equal to capital and what? Liabilities. Sawa? Yes. So that, I think, what you just need to know as far as this is concerned. This is concerned. So, and I think with that, we are going to do an illustration. Actually, I want us to do two illustrations, so that we can wind up with this particular topic here. So these are a small one. These are small topic. And basically we need to do away with it today. Remember, I say that this semester is quite short. We will try to move at a speed. Yes. So I want us to start with the, if you check on the handout which I've shared with you, I think there are like two questions on this. I want us to start with this one. August of 2024. That is a question I want us to start with. August of 2024. Question number what? Question number 5C. Question 5C. But I want us to take a short break. You take a cup of water, and then we come back. I want us to do two questions. so that we finish on this. So I want us to just take a short break of how many minutes are remaining to 9 p.m. I can see we have 7 minutes. We take a short break of 7 minutes. We come back at exactly 9. Make sure as we come back, you have this question with you. I've already shared these past papers. You go to the past papers which I've shared in the class WhatsApp group here. I hope you can see this. So those past papers which I've shared in the class WhatsApp group. So check the question or check the paper for August of 2024. August 2024, and exactly you go to question number 5C. So we come back after that short break. We look on this question and also another one. So see you after that short break. Yes, we continue. We continue because of time. I hope you already have the question with you. Do you have this question for August of 2024? Yes or no? Do you have this particular question with you? Do you have the question, Edith? Yes. Stephen, do you have the question with you? Felix, do you have the question? So if you have the question, please confirm so that we move together. So that we move together, Do you have the question with you? Do you have the question? Do you have the question with you? Do you have the question? Do you have the question? Doris, I hope you have the question with you. Okay. So what are we told here? What are we told? So basically we have the first part of that question, maybe part B briefly. We are told to explain the following terms as used in the account of professional practitioners. One, the office account. So in very simple terms, we have said an office account. This is an account, can we say is a bank account? Or basically is an account. Let's say it's an account whereby we record money belonging to the professional firm. And the current account is an account whereby we record money belonging to the client or money held on current behalf. As simple as that. So part C, the following trial balance was extracted from the books of 𝐎𝐒𝐋𝐈𝐍 and 𝐒𝐍𝐋𝐈𝐍, a firm of practicing advocates, as at 31st of July 2024. It's a trial balance. I hope you can be able to remember a trial balance. Basically, this is a list of balances which remains after balancing the ledger account. So at the end of the year, as an accountant, you balance the ledger account, you extract a trial balance. A trial balance, I hope you can be able to recall a trial balance, which you're saying is a list of all balances which remains. A trial balance has 3 columns. We have the first column, which is the details column, followed by the debit column, abbreviated by DR, and the last column, credit column, abbreviated by what? Abbreviated by what? Abbreviated by CR. Abbreviated by what? By CR. Abbreviated by CR. Abbreviated by CR. Doris, you're saying this is not a question for August. Huh? Doris, the question we are doing is for August. For August 2024. Yes. Now, if you're given a trial balance, basically, there are those items which appear on this column, and basically there are those items which appear on the credit column. So usually there is an acronym which I give to my student. The acronym is DIRA. DIRA is an acronym which we can split into two. So we have D standing for us, which stands for drawings. We have E, which stands for expenses. And then we have A, which stands for what? For asset. Which stands for what? For asset. This is very, very important. Now, these 3 items, this one do have a debit balance. Do have a debit what? Balance. When you're looking for drawings, for expenses and for assets, you can only be able to see those figures in this column here. In the debit what? Column. So, then this L stands for liabilities. Then this one stands for equity. Equity is another name for capital. And then R stands for revenue. Revenue is another name for incomes. All these items in the trial balance, they have a credit balance. Credit balance. So if you're looking for liabilities, capital, incomes, you can only be able to see those items in this column here. In that what? Column. That is important simply because, for example, when preparing the income statement, you're looking for expenses. Where do you look for the expenses? In the first column. If you're looking for incomes, you look for incomes here. When preparing the statement of financial position, you're looking for asset, you can only see asset. You can only get asset in the debit column. Capital and liabilities, you can only get that in the credit. column. Yes, so that is the trial balance. Now, having that trial balance, the first item you're given is the cash at bank, in the current account, in the office account, furniture, fittings, library books, insurance expenses, disbursement on current behalf, account payable, work in progress on 1st August 2023. This is the opening work in progress. We have current for the money held on their behalf. This, in other terms, is money held on current behalf. Cost charged to the client. This is an income. It is the fees or the cost charged to the client. We have the communication expenses, printing and stationery, rent and late, salaries, drawings, capital, and then we have additional information. Number one, you're told the uncompleted work on 31st of July 2024 was valued at 3,525,000. The work not yet completed at the end of the year. Which name is given to that? Which name is given to this? Who can be able to remember? Work not yet completed. Work not yet completed. Evans. Doris. Work not yet completed at the end of the year. The name given to that, Stephen, is which name? Work not yet completed at the end of the year. Yes. So the work not yet completed at the end of the year, we have referred to that as work in progress. Work in progress. And then number two, we are told depreciation to be provided at 20% per annum on book value of furniture, fittings, and library books. So remember, depreciation is an expense. What are we required to do here? A very simple question here. We're required to prepare the statement of profit or loss for the year which ended 31st of July 2024. And Roman 2, we are required to prepare a statement of financial position. If you come across such a question, you should always start smiling because these are just 3 marks. So we start with Roman 1. So statement of profit or loss. Whenever you're preparing this, you must have the complete title. Complete title comprises the name of the firm. Whatever you're preparing, we are preparing a statement of profit or loss, and it is for which year. So in the first paragraph, the name of this professional firm is 𝐎𝐶𝐒 and 𝐉𝐎𝐻𝐿 advocates, and this is a statement of profit or loss, a statement of profit or loss, which is also known as the income statement. And basically, this is for the year, which ended 31st of July 2024. 31st of July 2024. That's how your title should always look like. That is your title. That is your title. Okay, so having this, remember we should have 2 columns here. 2 columns here. And it is always important, if in the trial balance which you're given here, if you go up there, you'll be able to see we're given something like this. Something like this in the trial balance up there. It basically means that those figures which we are given in the trial balance, they are in thousands. In thousands means that in each of the figure given in the trial balance, the last 3 zeros have been omitted. For example, the first figure of 3,720, the actual figure should be 3,720,000, but the last 3 zeros have been omitted. So what you need to do, you also come here and you say that your figures are in thousands of shillings. So the figures you will write down here, the last 3 zeros have been omitted. Sasa? Yes. So you must do that. So what do we start with here? We start by recording incomes. We start by recording incomes. And now what you just need to remember is the format which I've already given you, the format which Morimo has already given you. So which incomes do we start with here? We start with the fees or the cost charged to the client. And that one is something given in the trial balance. And remember, that is an income. So if you go to the trial balance, you should be able to see the amount on the credit side. And I think that is somewhere in the middle of the trial balance. Can you see the cost charged to the client in the trial balance? How much is this amount? The cost charged to clients. Who can be able to see that amount in the trial balance? The cost charged to the client, or charged to clients, charged to the client. How much is this amount? Who can see that amount in the trial balance? Who can see that amount? We try to hurry up so that we do this question and another one. Yes, I'm told by Evans is 37,500. Can you see that amount? Once you see it, type it in the chat box so that I know whether we are together. Yes, so that is 37,500. 37,500. Now to this 37,500, we have said we do what? We add the crossing work in progress, and then we do what? We less the opening work in what? In progress. So that's what you just need to remember here. So this one, the crossing work in progress, this one is given in the additional information. This one is given in the additional information, whereas this one is given in the trial balance. Well, actually, that will always be the case. So the crossing work in progress will be given in the additional information. The opening work in progress will be given in the trial balance. I think we can first of all take what you're given in the trial balance, number one, not the trial balance, but in the additional information, number one. Below the trial balance, we have the additional information, the uncompleted work at the end of the year, which is the crossing work in progress. That one is the 3,525,000. And when recording any figure, when taking any figure from the additional information, you must be consistent. You must equally omit the last three zeros. So we will record that figure here as what? As 35,25. And then to this, we left the opening work in progress. Opening work in progress, we have it in the trial balance somewhere in the middle, and that is a figure of 5520. I hope you can see that amount. Can you see that work in progress? Can you see the work in progress at the start of the year? Yes, in the trial balance somewhere. So after doing that, we need to get something called the net cost charged to clients, the net cost charged to the client, the net cost which was charged to the client. So give me the net amount here. Give me the net amount here. Give me the net amount. Give me the net amount here. Give me the net amount here. Give me the net amount. The net amount, I'm given 35,775. That is 7,775. That is 7,775. Once you get the answer, so that I know whether we are together, type it in the chat box. Type the answer in the chat box. Type the answer in the chat box. I know whether we are together or not. Is that what you're getting? Is that what you are getting? Is that what you're getting? Yes or no? Is that what you're getting? Type the answer in the chat box so that I know whether we are together, whether we are moving together. Yes, yes. So now to this net cost charged to the client, we have said we should proceed and we add other incomes, the other incomes. So what do we need to do for us to check whether this professional firm had any other income? We basically go back to the trial balance here. And remember, you have said that all incomes, they have a credit balance. So when checking for incomes, you check the items appearing on the credit side. The figures appearing on the last column of the trial balance. Which figures do we have on the credit side? So you can see a figure of 4080, and that is account payable. Account payable is a liability, it's not an income. Down here, I can see a figure of 3720, which is money held on client behalf. Not an income, is a liability. Then below that, we have the cost charge, which is an income and has already been considered here. And down here, we have capital. Is capital an income? No. So it basically means that this professional firm do not have any other income. So in basically, we get what? We get the total incomes. The total incomes remain the same, 35,775. So that is the total what? Income. So after this, after getting the total incomes, we proceed and we do what? We less the expenses. We less the expenses. So now, expenses, remember, in the trial balance, expenses, we have said they have a debit balance. That's what you have said. You take the expenses there. But I think before we take the expenses in the trial balance, can we go to the additional information? The additional information. The information below, we have below the trial balance. And I think we have two notes. We have dealt with note 1 about the uncompleted work. But if you check on note 2, we have depreciation. Depreciation, we said, is the loss of money value of asset. So that loss of money value of asset is an expense to the business, is an expense to your business. So we have depreciation on furniture fittings, fittings and library books, library books. And we are told that this one will be 20% of the book value. Will be 20%. So what is the value for furniture, fittings, and library books within the trial balance? Within the trial balance. It is an amount of what? It is an amount of furniture, fittings, and library books. The value for that in the trial balance, I hope you can see that, is 6750. And is this figure correct, this one? This figure, is it correct? I'm told by Doris it would be 35,505. Is that figure correct? Yes, addition should not be a problem. Addition should not be a challenge. So we have 37,500 plus 3525 minus 5520. Where did you got this, Evans? So that is 35,505. 35,505. Okay, so let's compute this depreciation here. 20% of this, 20%. What are you getting here? Of that 6750. Yes, 20%. Watu wachangamke, ukipata answer unaitype kwa chat box, mwalimu ataiona. So that is the only way I can be able to know whether we are moving together. Once I see the answer in the chat box, I know that we are together. So, but if I can't see your answer in the chat box, I know we are not together. So, once you get the answer, type it in the chat box there. That's the only way I will be able to know we are moving together. We need to move together here. So, yes. So we have computed that depreciation. We don't have any other additional information. What do we need to do? We go back to the trial balance. And where do we get expenses? As per our acronym here, DIRA, we get the expenses here in the first column, the debit column. So can we take the figures in the debit column? The first figure up there is for cash at bank. Cash at bank is not an expense. So that is basically an asset. Below that, we have furniture is an asset. Below that, we have insurance expenses. Insurance expenses is an expense. Insurance expenses. How much is that? It is an amount of 1275 is an expense. So down front, we have disbursement on client behalf. That is an asset. I think I've explained what is that. It's an asset. Then down there, you can see another figure on the debit side of 5520 is work in progress, is not an expense. Down there, I can see communication expenses. Communication expenses. Remember, I'm only interested with the figures appearing in the debit column. As per our acronym, all expenses have a debit columns or debit balance, that is 2730. So then below that, we have printing and stationery. Printing and stationery is still an expense. Still an expense. Printing and stationery. Printing and stationery. That is basically an amount of how much? 5250. So below that we have rent and lease. Rent and lease. So rent and lease, that is basically an amount of 9,000 is still an expense. So below that we have salaries. Salaries are still what? Expenses. That's what we know. The amount you get from your boss is an expense. And that is an amount of what? 10,800. And then below that we have drawings. Are drawings expenses? Are drawings expenses? No, drawings, they are not expenses. Drawings, they are not what? Expenses. So I think we have those as the only expenses. Is there any expense which you have not included here? Is there any expense we have not included here, Evans? Doris? Any expense we have not yet included here? Any expense we have not yet included here? I think no. So we need to get now the total. Let's add all these expenses. We add all these expenses. We have 1350 plus 1275 plus 2730 plus 5250 plus 9,000 plus 10,800. So I'm getting 30,405. 30,405. 405. Someone to confirm whether that is what you're getting. Are you getting that value? Are you getting that total? Yes. So we need to erase that from the total incomes. And I think, yes, in our case, we will have a profit for the year because our incomes are more than expenses. So what will be the profit for the year? So we take this minus this. So I'm getting a profit for the year of 51. Confirm whether that is what you're getting. Are you getting a profit of 5,100? 5,100? 5,100? 5,100? Yes, yes. So that is it. That basically what was required in part Roman 1. And basically by doing that, the marks are located there were 4 marks. So let's move to Roman 2. In Roman 2, we are required to prepare what? The statement of financial position. The statement of financial position. And this one is prepared as at the end of the year. I hope you can see this one is prepared for the year, but this one is prepared as at the end of the year. As at the end of the year. How do we prepare this one? We prepare this based on the accounting equations. We start by recording assets, and these assets, we classify them into two. Non-current assets, and basically what? The current assets. So always we start by recording the non-current what? Assets. Remember, in our case, we just need to have a single column here. So have that so that we move together. Have that format here so that we move together. We move together here. We move together. We move together. Yes, I hope you already have that with you. You already have the format. So what do we start by recording here? The non-current asset. Non-current asset, I think I've given examples, motor vehicles, computer, furniture, and so on. I think this professional firm had only one non-current asset, and that is furniture. Furniture, fittings, and the library books. Now, this furniture, fittings, and library books, we record them here. We record them here at the net book value. Net book value means that we will take the value we have in the trial balance, which the value we have in the trial balance for furniture, fittings, and library books, the value of 6750. But now to this, you have to recall that this particular asset lost some value during the current year. You remember this depreciation? You remember this depreciation? This depreciation you have said is the loss of value, loss of money value of those assets. So if asset loses value, that means that the value for those assets reduces. So we less 1350 here. We less 1350. So what do we get? We get what? Zindo, we get 54. Evans, are we getting 54? Are we getting 54? Steven, are we getting 54? Are we getting 54? Doris, Edith, Ridian, are we getting 54? Yes, we get 54. Now, do we have any other non-current assets? Do we have any other non-current assets? No, because we don't have computers, we don't have furniture, and so on. So we proceed and record current assets. We proceed and record current assets. Now, for the current asset, we can start with what we have in the addition information number 1. Not in the trial balance. In the addition information number 1, we have the closing work in progress. This closing work in progress, we have said is a current asset. This is the work which was provided to the various clients by this audit firm, but because the work was not yet completed, the client had not paid for that work. So this money which our law firm is expecting to receive from the client is an asset. So it's a current asset. And how much is that? This one we get it from the addition information number 1. 35.25. 35.25. That's what we have. Then we go back to the trial balance, and remember you have said all assets, they have a debit balance. All assets have a debit balance. All assets. So let's check the items on the debit column. We will start with the first item in the trial balance, and that is the cash at bank. So we have said 2 accounts. An audit, a professional firm operates 2 accounts. The client account, this had an amount of 3720. And then we have the office account. The office account here. 8355. So these are assets, and that's what you can see in the trial balance. Those figures are on the debit column. So below that, we have furniture, fittings, and library books. That is a non-current asset. It has already been captured up there. Insurance expense is an expense. And then we have disbursement on current behalf. We say it is a current asset. Disbursement on client behalf. Disbursement on client behalf. How much is that? 13.5. 13.5. And then below that, we have account payable is a current liability. Work in progress. What we recognize is the closing work in progress, not the opening. Then remember you're checking the items on the debit column. So then down there, you can see communication, printing, rent, salary, drawings. We don't have any other asset. Any other what? Asset. So what we need to do here is we get the total assets. We get the total assets. We get the total assets. So let's add all this. Let's add all this. We add all this. We add all this. So we have 54 plus 35.25 plus 37.20 plus 83.55 plus 13.500. I'm getting total assets equivalent to or equal to 34.500. 34.500. 34.500. 34.500. Is that what you're getting? Is the total assets? Is that what you're getting? Is the total assets? Edit. Is that what you're getting? Is the total assets? Is that what you're getting? Is the total assets? Yes. So that is already confirmed there. Yes. So then from there we proceed. And remember we double underline that. That is the end of the first part. And then we proceed and we record the capital and liabilities. Capital and liabilities. So we start by recording capital. Capital is the last item within the trial balance. And that is an amount of 3,600. Remember to this, we We adjust capital in two items. One, we less the drawings. The drawings, that one is given as a second item from the bottom of the trial balance. The drawings, the drawings, the drawings, the drawings. So the drawings is an amount of 9,000, and basically this one we have said should be deducted from the capital, and then to this we add this profit for the year. Profit forward for the year. So the profit for the year is how much? Is 51. 51, this one. So what do we get? We get something called the net capital. We get something called the net capital. So how much will be our net capital here? How much is our net capital? And I hope we are together up to that point. I hope you're together up to that point. Are we together up to that point, Doris? Are we together up to that point? Stephen, Ridian? Are we together up to that point? Are we together up to that point? Yes, we are. We are. So what are we getting here? What are we getting here? 3,600. 3,600 minus 9,000 plus 51. I'm getting 26 what? 700. 30. Yes, 26. 700. Yes. Now to this we proceed and basically record the liabilities. So for the liabilities we start with the non-current liabilities, and you have said a professional firm, or the only non-current liability which a professional firm may be having is a bank loan. Is a bank loan. If you check on that question, we don't have a bank loan. Finally, we record the current liabilities. The current liabilities. Now for the current liabilities, I think we have a number of them. We check the items appearing on the credit side. All liabilities have a credit balance. Can we check the items appearing on the credit side of the trial balance? The items on the credit side of the trial balance. I can see a figure of 4080. What is that? That is account payables. Account payables, this is the amount of money which is owed to the suppliers. Owed to the suppliers. How much is that? 4080. So then down here, I can see an amount of 3720. 3720, what is that? That is money held on current behalf. That is still a liability. If you have a professional firm and you hold money on behalf of your client, that is basically what? A liability. Money held on client behalf. So, and that is an amount of 3720. Below that, we have the cost charged to the client. Remember, that is an income. And down there, you can see we have capital, so which is not a liability. And I think we are done. So we don't have any other current liability. So what we need to do here is we get the total capital and what? Liabilities. Total capital and liabilities. And that one should also give us that amount. So you need to add this. This is the capital and this is the liabilities. So after adding that, we should have the same amount as what? Or we should have an amount equal to the total asset. So can you confirm whether you're getting that amount? Are you getting that amount there? Are you getting that amount? Are you getting that amount? Are you getting an amount of 34,500? Are you getting an amount of 34,500? Are you getting an amount of 34,500? Yes, 34,500. Yes, so that basically what was required as far as that question is concerned. And basically by doing that, the marks allocated here were 5. Well, good, were 5. Were 5. or 5. Yes. So that's basically how we prepare those financial statements of a professional firm. Is that something simple, or the topic is complex? Have you understood what you have done here? Edith, how is the computation? Simple or difficult? Simple or difficult? Simple or difficult? I'm told by Evans is very much simple. I hope that is the position. Asa, is that the position? Have you understood what you have done here? Have you understood what you have done here? Have you understood what you have done? Now, if yes, there is a similar question to that. A similar question to that. Maybe I can just guide you on this one and I give it to you as an assignment, because the two questions are just the same. Just the same, just the same. So this one, August 2022, specifically question 4B. I want to guide you on this. And those papers which I've shared with you, I don't know whether they have that paper. Let me share another batch. Those papers, there are some questions which are missing there. There are some questions which are missing there. Some papers, that is. So let me share another batch. I share another batch. Another batch of past papers. Okay, so I'm looking for that. I don't know whether I have that. I can see it is missing on my phone. I think it was deleted. Okay, let me post a photo in the class WhatsApp group so that I can guide you. So, and then I will be able to edit, remind me to share that batch. Okay, I think it has already been shared there in the chat box, but I can maybe post a photo of the same. Yes, I've already shared that in the class WhatsApp group, a photo of the same. Can you go to that question? I just want to guide you in the next 5 minutes. The two questions are just the same. This question and the one which you have done here, they are the same, but maybe with a very slight difference, So are you there? Doris, Edith, Zido, are you there? Stephen, Lydian, are you there? Evans, are you there? If yes, please confirm so that I can guide you in the next 5 minutes. Then we call it a day. Okay, so if you're there, what are we told? What are we told in that illustration? We are told S and M, an advocate operating under the name of SM Advocate. The firm's trial balance for the year which ended 30th of June 2022 is as shown below. So we are given a trial balance there. We are given the cost charged to the client, the work in progress at the start of the year. That is the opening work in progress. The client for money held on their behalf. This is money held on client behalf. Creditors, those are the same with account payables. If you're given creditors, those are equivalent to the account payables. So that is a current liability. And then we have receivables. In case you're given receivables you have said is a current asset. You come and record that here. Is a current asset. Is a current asset. And then we have the office expenses. That is basically an expense. It goes to the income statement. Furniture, fittings, and library books. That is a non-current asset. We have cash at bank. That is basically the same with what we have here. Is a current asset. Postage, telephone, internet bills, printing and stationery, rent and rates, salary to staff, all those are expenses. Drawings, you left that from capital. And then we have disbursement on current behalf, the same, is a current asset. And then capital is the same. So then in the additional information, we have now 3 additional information. Number 1, you're told it is estimated that bad debts amounting to 16.5 are uncorrectable and should be written off. So bad debts, this is the money which, for example, if you have a business and you have maybe provided services to your customers or to your clients on credit, you expect that some of them will not pay you. So what do? This amount which is to be written off, the bad debt written off, budget written off of 16.5. Number 1, this one you account for it as an expense. You account for that as what? As an expense. Account for that as an expense. And then number 2, this also reduces the receivables. You will account for this as an expense. And number 2, you deduct that from the receivables. So the receivables figure, which you record here, would be equal to the amount of receivables in the trial balance, 234,000, minus this amount here. Because the receivables is money which you expect to receive from your customers. If you're expecting that some of them will not pay you, you will have to reduce this amount of receivables. I think that is the only difference between this question and the other. So that bad debt written off is an expense, and also you deduct it from the receivables. Depreciation is just the same with the other question. I don't think we have any problem. Compute that depreciation, recognize it as an expense, and then deduct it from the value for furniture, fittings, and library books. Number 3 is uncompleted work. Uncompleted work, which is now the closing work in progress, just like what you have done in the other question. So you add it to the cost charged to the client during the current year, and still you treat it here as what? As a current asset. As a current asset. So I think the 2 questions are just the same. The only difference is the additional information number 1. Can you see that? Can you see that? Can you see that? Yes, the 2 questions are just the same. The only difference which exists is what? The additional information number 1. So what I want you to do, I want to give that question as an assignment. As an assignment, and remember what we agreed. What we agreed on Tuesday. Take into account this semester is very, very short. Once I've given as an assignment to you, because we may not have time to come back to that question, make sure you attempt that question on your own. In case you have a problem, get in touch with the Mwalimu and ask the question. Ask the question you may be having. Sasa, yes. Make sure you attempt that question. And in case you have any problem, you let me know. Equally, once you have attempted, you can send your solution to me. I have a look on it. In case maybe there is somewhere I need to guide you, I'd be able to guide you. Sawa? Yes. So that question, make sure you do it as an assignment. And then once now we meet on Saturday, we are going to move to topic 2. We are going to move to topic 2. I'll be able to see what we are going to cover on Saturday. But basically, once we meet on Saturday, we move to topic number what? To topic number 2. So for today, I want us to stop at that point. I don't know whether there is any question. Is there any question? Is there any question before we call it a day? Any question? Do we have any question before we call it a day? Any question? Any question? Doris, Edith, Zilod, is there any question? Ridian, any question? Stephen, any question? Doris is saying there is a question. What is the question? What is the question? And the video will be shared tomorrow. Maybe from tomorrow I'll be able to share the video for the first class. And also today's class. The videos will be shared. The video will be shared tomorrow. I think this should be the first class, because I think what we did in our previous class, we just discussed the course outline. So these are first class. I hope you can see that is topic 1. So that's why I'm saying the videos will be shared from tomorrow. Will be shared from tomorrow. Will be shared from tomorrow. From tomorrow. From tomorrow. From tomorrow. So Lydian has just joined. So Lydian, this is our lesson number 2. In our first lesson, which was on Tuesday, we just discussed the course outline. And I think from tomorrow, I'll share the 2 videos, the video for Tuesday and today's video, so that you can be able to do what? To catch up. Awesome? Yes, I'll be able to do that. Remind me, edit tomorrow morning, so that I work on that. Sawa? Yes. So let's stop at that point. Have a good night. I'll see you on Saturday.
Good evening, class. We have what we call security services, security services, security services. That's an input VAT. Then lastly, purchase of computer. Purchase of computer. Purchase of what we call computers. Purchase of computer, that's an input VAT. So then the last additional information, the examiner tells us the above transactions was stated exclusive of VAT at the rate of 16%. That the above transactions was stated exclusive of VAT. Transactions was stated, we're told exclusive. We say of what we call of VAT. So when you say exclusive of VAT, what do we use when you say exclusive of VAT? When you say exclusive of VAT, VAT has not been charged, so we use 16 over 100. 16 over 100. So then we proceed to the required. The examiner tells us determine the deductible input VAT. If examiner tells you determine, what we call determine, we're told to determine what we call the deductible input VAT. So in this case, we basically examiner implies that you cannot. So you cannot, it basically means that you cannot trace purchases, we say that was sold, we say as exempt. You cannot basically trace purchases that was sold as exempted. And therefore you are restricting. In this question, we restrict, and therefore we are restricting together. And therefore we are restricting. We respond with a yes. And therefore we are restricting. And therefore we are restricting. And therefore we are restricting. We respond with a yes. So I want us to start with the output VAT, though that is additional information number 2. we can start with the output VAT. So we have the output VAT. So the output VAT, we have the nature of supply. What do you call the nature of supply? We have the VAT amount. We have the VAT rate, and then we have the VAT. So we have the nature of the supply, we have amount, we have the VAT rate, and then we have the VAT. So number one, we have sales to local market. What is the figure? So what is that VAT? Sales to local market. 3.4 times 16 over 100 times 16 over 100. What do you have? So that is 544. Sales to foreign market. Sales to the foreign market. So times 0 times 0. Sales to the foreign market times 0. Times 0. So that is the next one. In essence, to foreign market, that should be export. Export. So you have to write 0. Then we have exempt. We don't need even to put it there, but we can just put it for the sake exempt. So exempt in this case exempts the sales. The figure is 2350. We don't charge. So what is the total? Total output VAT. So what is the total output VAT? Is that understood? So the answer is 2 marks. The question is 2 marks. Where are the 2 marks? The 2 marks is this and this. Once you have that, then that's okay. So together, we'll respond with the yes if you're together. Is that understood? So then I want to get the taxable supplies. We normally say that the taxable supplies is equal to the standard rate plus 0 rate. So we can get the taxable supply in this case. That should be 3.4 plus 5 million. So what is the total? What is the taxable supplies? So the taxable supplies of the two, we get them to be 8.4 together. So taxable supply is 8.4. Is the taxable supply 8.4? Is the taxable supply is 8.4? Perfect. Then we get the total supplies, what we call total supplies. So total supplies, we have total supplies. So that should be the standard rate plus the 0 rate plus the 0 rate plus exempt. Plus exempt. So in that case, we are going to have 3.4 plus 5 million plus 2350 plus 2350. So what is the total? What is the total supplies? Give me the total supplies. So the total supplies in this case, that's 10,750. Total supplies should be 10,750. So that is 10,750. That is essentially 10,750. So that should be 10,750. 10,750. So then we get what we call total input VAT. We get what's called the input VAT. So we have the nature of what it costs supply, amount, the VAT rate, and then we have the VAT. Somebody's talking. Kindly. And then we have the VAT together. So the first one we have cash purchase. We call it the cash purchase. Cash purchase. That is 1.3. 16 over 100. 16 over 100. 16 over 100. 16 over 100. So what is that? 16 over 100. So that should be 208. We have it as 208. So the next we have what we call credit purchases. Credit purchases. Credit purchases. So for the credit purchase, we have a figure of 22.50. So we have 16 times 16 times 16 over 100. So credit purchases times 16 over 100. So that should be 360. 360. We have the 360. Salaries and wages we know is exempted. So we have the legal services. So for the legal services, we have it as 650 times 16 over 100. So what is 650 times 16 over 100? So we have it as 104. As 104. So then we have what we call stationery. Stationery was 720. 16 over 100. 16 over 100. For the stationery 16, that is 115, 200. 115, 200. So we have what we call warehouse rent. Warehouse rent. So for the warehouse rent, the figure is 400,016 over 100 times 16 over 100. That is 64. That should be 64. Then we have security services. So for the security services, we have 680. So what do you have? Security services, 16 over 100. What is the figure? Very fast. So somebody tells me 108, 800. Then you have the last one, purchase of computer. Purchase of computer. So what do you have? Trace of computer. $19,200. So we have what's called the total. Total input VAT. Total input VAT. Total input VAT. Total input VAT. So what is the total input? $979,200. We have $979,200. But you're told that we carry out what's called deductible input VAT, implying that we cannot trace purchases that were sold as exempt. We cannot trace purchases that were basically sold as exempt. So what do? We restrict. So deductible, we say deductible input VAT is equal to the taxable supplies over what you call total supplies over total supplies times what you call the total input VAT times the total input VAT together times the total input VAT together times the total input VAT. We respond with a yes. So number one, team, again, if sales were inclusive, we make the sales exclusive altogether. But for this particular question, the sales are already exclusive altogether. The sales are already exclusive. So we don't need to make the sales exclusive, the standard rate to be exclusive, because the standard rate sales are already exclusive. So we just get the total taxable supplies, which we have as 8.4 over total supplies that we have as 10. We have it 10,750 times what you call times the total input VAT, which is that figure. So we get what's called the deductible. We call it the deductible input VAT. What is the deductible input VAT? What is the deductible input VAT? Taxable supplies, which is 8.4 over total supplies, which is 10,750 times 979,200. So we have it at 765,142. 765,142. This is the deductible input VAT. How do I get the VAT payable or refundable? So we understand the VAT payable, so what we call refundable, is equals to the output VAT minus what we call the deductible input VAT minus the deductible input VAT. So the output VAT is 544. Then we have the deductible to be 765,142. So this is basically a refund. So this is basically a refund, VAT refund. So what is the VAT refund? When you let's start, what is the refund? What is the refund? So the refund is 221,142. 221,142. All of us, are we together? All of us, are we together on that? All of us, are we together? Perfect. I want us to pick the last question, then we go to capital allowance. To do the last, then we get to capital allowances. Capital allowances. Is there anybody with a question? Kuna mtu na swali? No one has a question. So I can wrap it. Let me pick a bit of more of a complex question, not so direct together. Let's see a question that is complex. November 2019 is a bit complex. November 2019, we'll pick a question on November 2019. That should be November 2019. November, we have it as 2019 on the VAT, the bit technical. Open November 2019. November 2019. If you're on it, we respond to this. November 2019, that is question 2C. November 2019, question 2C. If you're on it, we respond to this. If we are on it, we respond to this. The link is there. It is in the group. The link is there. The link is there. Somebody just to forward the link. The link is there. Once you get it, you tell Mwalimu. Once you have it, everything you need is there. Everything you need is there. So then I can start. Can I start the question? So being told that the following are summaries of details of sales daybook and purchase daybook, details of what he calls the sales daybook and purchase daybook, and the cash book for Kamata and the cash book for Kamata Limited for the month of December 2018. So when you talk about sales daybook, what is a sales daybook? What is the function of a sales daybook? The function of a sales daybook. What is the function of a sales daybook? So we say that sales daybook, we basically record what we call the credit sales altogether. We record what we call the credit sales altogether. We record what we call the credit sales altogether. Purchase daybook, we basically use it to record what we call the credit purchases. So we have on December 4th, we have Mwangaza Limited. The figure is 650. We have 𝐿𝐿, the figure is 520. We have 𝐎𝐍, and remember 𝐎𝐍 is export. How would you treat an export? 𝐎𝐍 is export, and the figure is 350. So that is zero rated IVA. Then you're being told that on 20th, we have the 20th. So the figure for the 20th, we have what's called the figure for the 20th, we have Ministry of Sport. The figure is 170. What do you say about ministries? What do we understand with the ministry when you're told ministry? When you're told ministry? Eva, kindly can you help somebody who can just screenshot the paper? Douglas is struggling to, I don't know why he's struggling to get the paper. November 2019, sign kindly, somebody to assist on that. Douglas, do you have the link? The link is just, is pinned in the group. Somebody, let's make sure that we support our brother. Has it been done? Somebody has done the paper. Douglas, is that okay? Somebody has done. Thanks. So I've said that the sales daybook is basically to record credit sales, and purchase daybook is basically to record what you call the credit purchases, is to record what you call the credit purchases. So we have December 4th, that is on the December 4th. We have Mwangaza, that is a figure of 650. That is an output VAT. 𝐿𝐎𝐂𝐒, that is an output VAT. 𝐼𝐍 Enterprise, that is an output, but remember that is zero rated. We charge VAT at 0%. Then we start with the Ministry of Sport. The figure is 170. What do you know about Ministry of Sports? When we talk about government ministries, those who say are VAT withholding agents. Are we together? Those are VAT withholding agents. We are going to withhold 2%. So then we proceed to what we call the purchase daybook. So we have Jawabu Enterprise, that's an input VAT. We have what we call Sonitech, that's an input. But remember, import is basically charged VAT after charging the import duty. So the figure is 420. We have 𝐿𝐴𝐿, that is, the figure is 200,000. Then we finally have what we call 𝐵𝐶𝐿𝐴. The figure is 180,000, giving us a total of purchase daybook to be 1,110,000. So we look at this together. We look at the figure. So they told that we have a cash book together. What do we use a cash book for? When you have a cash book, what do we use a cash book for? What is the work of a cash book? What is the work of a cash book? When you say a cash book, essentially, what is the work of a cash book? To record receipts and payments together, cash transactions. So number one, we have the figure for the sales. Look at the figure for the sales. So we have the cash sales, that is cash and bank. What is the total cash sales? We can have the total cash sales. So we can have the total cash sales. What is the total cash sales? We'll have it as 960 plus a figure of 450. So what is the total cash sales? What is the total cash sales? What is the total cash sales? Cash sales. So we have a figure of 1410. We have a figure of 1410. So are we going to charge VAT on that? The question is, are we going to charge VAT on that? Are we going to charge VAT? Yes, we are going to charge VAT on that. Then down there on the debit, We are told receipt from debtors. Receipt from debtors. Are we going to use the figures for the receipt from debtors to charge VAT? Are we going to use those figures for the receipt from debtors to charge VAT? No, we are not going to account for that. Perfect. So then we go to the payment side. That is the right-hand side. Number one, we have salaries and wages through the bank. Do we claim input VAT on salaries and wages? Do we claim input VAT? Do we claim input VAT? So we don't claim on salaries and wages because that is exempted. We have the next what we call catering expenses. Catering expenses. When you talk about the catering expenses, catering expenses, that is non-deductible input VAT. Then you have what we call purchases. We can do the summary. Total purchases, we can get the total purchases. Total cash purchases. So we have 5. The figure is 580. And then we have 640. So what is the total cash purchases? What is the total cash purchases? So the total cash purchases is 1220, 1220, 1220. The total is 1220. So that is, we are going to claim. So then we have what we call furniture. Furniture. Are we going to claim VAT on that? Are we going to claim VAT on that? Why do you say no? Even we've not read additional information. Why do you say purchase of furniture? We are going to claim VAT unless that person is unregistered. Unless that particular individual is unregistered and registered, then we have electricity. Yes, we are going to claim. Next, we have photocopy. Photocopying, yes. The refund to customers. We have a figure of refund to customers. So for the refund to customers, we can adjust this. We can adjust this to less refund. We can refund customers. We can adjust refund to customers. How much is the refund to customers? How much is the refund to customers? What I've been told is the refund to the customers. The figure is 176. So we have 176. So what is the adjustment on sales? If we less refund to the customer, the adjustment is, what is the adjustment on the sales? So that is 1234. Thank you. So I proceed to the additional information. So being told that 𝐻𝐿𝐒𝐂𝐒 was declared bankrupt. 𝐻𝐿𝐒𝐂𝐒 was declared bankrupt. 𝐻𝐿𝐒𝐂𝐒 was declared bankrupt on the 18th of December, 2018, after having paid 400,000 for the goods purchased on 7th December, 2018. When somebody is declared bankrupt, what do we do? So remember that 𝐻𝐿𝐒𝐂𝐒, the total figure was 520. So we claim a bad debt relief on, or is it on the whole 520? No. So you're going to have 520 minus 400. We claim a budget of relief on 120, on the figure of 120. We claim it on the figure of 120 together. We claim a budget relief on the figure of 120 together. So then we've been told that additional information, 10% of purchases from Jawabu, 10% of purchases from Jawabu were returned by the company due to poor quality. 10%. Those are returned. They are returned out. Is it outwards or inwards? Return outwards. Are we together? Is it return outwards? 10% is return outwards. So that reduces the purchase 10% off. From Jawabu, that should be 300,000. So what is the 10%? What is the 10%? That is return outwards. So return outwards. So that should be 30K. We have that as 30K. So then we're being told that a credit note amounting to shillings 280 were issued to customer during the month. Were issued to customer. A credit note amounting to 280,000 were issued to customer. Are those credit notes issued or credit notes received? Are those credit notes issued or credit notes received? And how does it affect the VAT account? Is that a credit note? That is a credit note issued. So does it affect the sales or does it affect the purchases? The credit note issued, does it affect sales? Yes, that affects the sales by reducing the sales. Thank you. So the interest of refund to customers in the cash book relate to excess amount paid on cash sales. We have adjusted. Is that okay? That figure is already adjusted at that point. That figure is already adjusted at that point. So then we are being told that all purchase invoice. So we're being told that a purchase invoice of 220 from Dubai traders was omitted from purchase daybook. From Dubai traders was omitted. If a purchase invoice was omitted, how do you correct that? If a purchase invoice was basically omitted, we add it to the input. We definitely add it to the input. If it was omitted, we add it to the input. Then lastly, the examiner tells us all the transactions above are exclusive of VAT at a standard rate of 16%. At a standard rate of 16%. Are exclusive of VAT at a standard rate of 16%. That all the transactions above are essentially exclusive of VAT at a standard rate of 16%. What do we use? At a standard rate of 16%. At a standard rate of 16%, we use 16 over 100. So then we're being told required, prepare a VAT account for the month of December 2018, showing what we call the VAT payable or refundable, if any. Showing VAT payable or refundable, if any. VAT payable or refundable, if any. So we are not going to go for a break, but we'll have to finish this question first before we get to a break. Is that okay? We are going to finish the question first before we take a break. So, does this question involve restriction? Does this question involve a restriction? No. Does it involve a restriction? No. So we can use the VAT account. So then this business is basically called Kamata. Kamata, I'll call it Kamata. I'll call it Kamata Limited. And I call it VAT account. VAT account. We say for DEC 2020-2018. So we can make it. So this side is what we call the output. VAT. This will be the input VAT. So we have the output VAT, and then we have the input VAT. So we start with output. So we have nature of what we call of supply. We can say supply amount. We have the VAT rate, and then we have the VAT. So on this side, we have also the nature of what we call of supply. We have what we call the supply amount. We have the supply amount. We have the VAT rate. Then we have the VAT. So the first one we have what we call output. We have what we call, if we like, we can put the date, but not a mass, We have Mwangaza. So we have Mwangaza. So Mwangaza is a figure of 650. Supply amount is a figure of 650. We have 16 over 100. What is the figure? Mwangaza 650 times 16 over 100. Get that very fast. So 104. We have 104. 104. Then we have 𝐍𝐿𝐒𝐂𝐒. So 𝐍𝐿𝐒𝐂𝐒 was 520. We'll adjust those times 16 over 100. Times 16 over 100. Get formulas. ℎ3,200. 83,200. So then we have the next. 𝐎𝐍 is export. So then we have Ministry of Sport. So what is that to get from that? Then you can have the VAT withholding. Get from that. Just 27,200. So get from the withholding. The VAT withholding, 2%. That is 34. Because it's a VAT withholding agent, you'll not receive the whole amount together. That will be withheld. So then we can come to the purchases. We move with the purchases. We have Mwangaza. So Mwangaza is a figure of 650. So the VAT rate is 16 over 100. Get for me that Mwangaza. 16 over 100. Give me that Mwangaza. Jawabu, sorry. Thank you so much for that. Thank you so much. So what is the figure for Jawabu? Thank you. What is the VAT on that? What is the VAT? Yes, I have corrected. 48,000. Sonitech. So the assumption is that we've included import duty. We have included import duty on that, times 16 over 100. So give me that for the Sonitech. Sonitech. Sonitech nipatie. The assumption is that import duty 67,200. So then we have the next 𝐿𝐿. So 𝐿𝐿, the figure is 200,000 times 16 over 100. So get for me that 16 over 100 times 16 over 100. So that we have, somebody gets his 32. 32. Then we have 𝐵𝐼𝐶. So 𝐵𝐼𝐶, 180. 16%. What is 16%? 28,800. So we come to this, we have what's called the cash sales. After adjustment, what is the figure when we less the 176? What was the cash sales adjusted? That was 1230. Somebody give me 1230. Then you get 16% of that. What is that? Yes, give me that 16. So 197 for 40. Then you had the purchases. What is the summary for the purchases? Cash purchase. Cash purchase. What is the summary for the cash purchase? Provide me the summary for the cash purchase. Provide me with the summary of the cash purchase. So 1220. %, get me. $195,200. $195,200. We have furnitures. So furniture was a figure of 160. Get me that. 16%, 25,600. Electricity. %, of that. 16%. That is 51. We have the photocopy. What is 16% of that? %, of 24. 3840. So then we have what's called the bad debt. Plus, because we don't have restriction, team, because we don't have restriction. You can have the budget on this side. If you have it on the input side, it will be a positive. I'm saying, whenever you're dealing with, you're not dealing with exempt, you can have the budget at this side. If it's on this side, it's a negative. If it's on the other side, it's a positive. It's a positive together. So what is the budget? The budget was 120. 16% for the budget. So that's a minus. %, will return to Jawab. Return, we call it outwards. Suppose it's on this side, it would be positive. This side, it would be minus. That should be 30. So what is the figure for the return outwards? Get me that. So we have 48. So this figure, I hope you're getting. You can use this figure interchangeably. If you have return outwards here, it will be positive. It will be a positive. Are you getting that? If you have the budget on this side, it will be a positive. It will still give the same value. That is in case we do not have exempt. Is that understood? So if you're together, we give it a yes. If we are together, we respond. Thank you. Then we have a credit note amounting to this was issued. So we have a credit note issued. Credit note issued. So the credit note issued is a figure of 280, 16%. Well, less than. Or you can have this and have it as a positive. What is the credit note issued? $44,800. $44,800. So then we have the next is omitted invoice. Call it omitted. So the omitted invoice is 220. Get from it. Omitted invoice, get from that. That's 5,200. Is there an entry that we have not done yet? So which side is bigger than the other? Is it the output or the input side? To get the balancing figure. Which side is greater than the other? Is it the input or the output side? Is it the input or the output side? So what is the figure for the input side? What is that figure? If you add it to give us the add that so that we can get the figure. Kindly very fast. I want to come and do a question on investment allowance. So make sure that you finish that. Give me this so that we can do a question also on investment allowance. Tafadhali. There's a question that I want to pick. So is it 436,160? 436,160? Is that the figure? Input. Is it, what is the figure? Somebody to confirm, not only one person. Either say 436. To do work with either. Either's 436,160. Is it correct? 436,160. So we have what's called 436,160. So then if that is what, then we are going to have what's called a VAT refund. What is a fund? So what is the refund? VAT refund as a balancing figure. Is that 91,720? Is it 97 or 91,720? Which is which? 𝐎𝐿𝐶𝐒 91,720. Douglas is getting 97. What is the figure? 𝐿𝐶𝐒 says 91. Douglas says 97. $91. So let me work with the two. So we have solved that question. Is there anything complex in this question? Is there anything complex? Is there anything complex? Have you all understood this question, this VAT question that I've done? Have we all understood? Yes. Can I rub it? Can I rub it? Okay. So we come back and now we start on investment. We do questions on investment allowance. We do a question on what we call on the investment. I want to pick a smaller question that we can finish. There's a smaller question that we can finish. I can give the question so that when you come back, something on December 2023. Somebody to open December 2023. There should be something on investment, a much smaller item on that. Yes, question 4C. Question 4C. December 2024, 2023, deck 2023. We have this question 4C. So as we go for a break, this is a question that we're coming to do on investment allowance. Is that noted? We are coming to do that on investment allowance. As we take a break, is that noted? And we have to finish that. Can we begin that question? Can we begin the question? Can we begin the question? Can we begin that particular question? So perfect, we can see it. We can see with that question. So we are being told, Fountain Limited manufactures soft drinks for sale in the local market. The company started operation on 1st January 2021 and acquired stroke constructed the following assets. Acquired stroke constructed the following assets. So number one is a factory building. The year is 2021. The figure is 40 million. So it qualifies for investment allowance at what rate? That is a factory building. It qualifies for investment allowance at what rate? 50% in the first year and 25% per annum on the straight line. That is from the second year on the remaining balance. What about the factory machine? First year should be 50%. Then the second year is 25% on a straight line on the remaining balance. That is from the second year. Then we have what we call the lorry. Lorry that qualifies for wear and tear, that is at the rate of 5%. We have a go down, a go down, a go down. Go down is 10%. Computer, that should be, computer should be 25%. Then we have computer softwares. Computer softwares should also be 25%. But look up on this saloon car. Which year is that? Saloon car is 2022. What is the rate for the saloon car? The rate for the saloon car is 25%. But remember, we restrict to 3 million if the value is more than 3 million. Then other machineries, where will other machineries go to? When you're told other machineries will go to 10%. So being told to compute investment allowance for Fountain for the year ended December 2021 and 2022. So Fountain investment we'll call it a Fountain Limited. We have it as investment. Allowances 2021. So 2021. So we call it nature of what I call of the item. Nature of the item. We have the qualifying cost. We have investment. Investment allowance rate. We have what's called the investment allowance rate, the investment allowance rate, the investment allowance rate. Then we have the investment allowance. Then you have the residual. Are we able to see that? Are we seeing that? If we can see that clearly, we also respond with a yes. So we start with the factory building. Qualifying cost, that is 40. The rate is 50% for the first year. That should be 20. Residual is 20. So I have the next factory machine. Factory machine. What is 50%? 50% of 12,500,000. What is 50%? That should be 6,250,000. 6,250,000. 6,250,000. Then you have lorry lorry. So the figure is 10 million. The rate is 25%. That should be 2.5. 2.5, that should be 7.5. That should be 7.5. Then we have it go down. We have it go down. So a go down is 4.1. So that should be 10%. That should be for 10. What is the balance for 10? What is the balance for 10? What is the balance for 10? Provide me that balance for 10. That is 3690. So then we have what we call computers. Computers. Then you have computer software. Computer software. That should be 240. Then 5%. 25%, that should be 60. Then that should be 180. Remember, that is for 2021. So 2021 ends there. So what is the investment allowance for 2021? Investment allowance for 2021. So get it for me, the investment allowance for 2021. Get it for me. For 2021, 20 million plus 6,250,000 plus 2.5 plus 410 plus 260. Wonderful people, give me that. So provide me that. So give me the figure, kindly. Give me the figure. $29 for 20,000. 9 million. So that's okay. 2021, is that understood? Is 2021 understood? Is that understood? If that is understood, we respond with yes. So those are 7 entries. So I want to use the same. I just want to rub and use the same. So on the second year, what do you use for the factory? We use the remaining balance, and now the rate is 25%. So 25% of 20 million, what should you have in 2022? 25%. Now for the second year is 25% on the remaining balance on a straight line. What is it? So that should be 5 million. 5 million. This should be 15. Tuko sawa. Are we together? You give me a yes if we're together. Kama tuko pamoja, you give me a yes. Thank you. So then we proceed on the second year. We use the remaining figure that should be 62.50. We also use 25%. What is 25% of 62.50? 25% is 15,62,500. 15,62,500. 62,500. So minus this 6250 minus 1562,500. What is the balance? What is the residual? What is the residual? What is the residual? 46,87,500. 46,87,500. Then we have the lorry. Because of the straight line, we still use 10%. The figure remains the same because on a straight line, the only thing we'll remember is to remove 2. So the remaining amount is 5 million. Is this understood? We say that for wear and tear, then are on a straight line. So the same, unless there's a disposal, the figure remains 2.5. But remember, we're also losing another 2.5. 2.5. Is that understood? If that is understood, we respond to the yes. Is that understood? Perfect. So again, I move to the go down. The figure remains the same because on a straight line, the figure is, so less for 10 on this. Remove for 10 on that. Remove for 10 on that figure. That's 690 minus for 10. That's 6 minus for 10. Is it 4280? Is it 4280 as the balance? Mwalimu is requesting. What is the balance? That's 690. It's 30, yeah, 3280, not good. 3280. Computers again is on a straight line. We use 800,000, but remember we remove for that. This again is same, that is 240. But remember we remove the 60, so this should be 120. So we introduce those items for 2022. The examiner is very clear. We have the saloon car. Remember, this is restricted. So the value should have been 7 million. So we are only going to use 6 million because that's restricted 3 million, 25%. That should be 1.5. So that should be 4.5. We have that as 4.5. That should be 4.5. Then I have the last one, we call it other machineries. Other machinery, that should be 3. We use 10%. That should be 30. This should be 270. So what is the total investment allowance? Give me that. Investment allowance, give me for that. Add, you simply need to add. I'm waiting for that figure. Alan, why did you provide me that figure? 5 million, 1,562,000, 11,262,500. Again, 1, 2, 3, 4, 5, 6, 7, 8. So 8 plus the 6, 8 plus the 7, that should be 15. So just need any. The investment allowance in this question was, the figure was 6 marks. So any 12 times a half, then you have, you say, 6. Is that question sorted conclusively? Well, is that question done perfectly well? So on a Monday, we pick it from there. On a Monday, we pick it from there. Unless somebody has a question, but I beg to stop at that point. Unless somebody has a question, I beg to stop at that point. Are we all sorted? Is the questions sorted perfectly well? So I beg to stop at that point. Just a reminder, we said we would meet tomorrow in the morning. We'll finish tomorrow in the morning, the public finance tomorrow in the morning. So we keep time 5. We keep time, we make it 5. We keep time, we make it 5. So God bless you and God bless our class. Our class is ended. We can stop it at that point. Blessed night, I will call. Good evening, class. Perfect. So I want us to embark on our revision, and I want us to start our revision on VAT. The first question that I want us to revise on the VAT, the first question, that is April 2024, April 2022, sorry. We have it as April. VAT, April 2022, VAT, April 2022, April 2022. That should be question 2. On the VAT, April 2022, on the VAT. So are we there? Are we on it? April 2022? If you're on it, we'll respond with a yes. Perfect, if you're on it. So that is question 2, Roman C. So question 2, Roman C. Question 2C. Can we start on that question? Can we start on that question? Can we start on that question? Thank you, Douglas. So being told the following, we're being told that the following were extracted from the books of Intercity. The following were extracted from the books of Intercity Limited. And you're told for the month of January, 2022. So the company is registered for value-added tax purpose. So number 1 is sales to the local market, 3.4. How did you sales to the local market? How did you sales to the local markets? That is an output VAT. That is an output VAT. What about sales to the foreign market? Sales to the foreign market. Sales to the foreign market. Output but at zero rate. Then finally we have exempt. We have exempt. We don't charge VAT at all. So then we're being told that purchases and expenses incurred during the month were as follows. That purchases and expenses incurred during the month were as follows. Number one is what we call cash purchase. Cash purchase. Are we on it? Cash purchase. Cash purchase. How to treat the cash purchase? That's an input VAT. Then you have the credit purchase, a figure of 2,250,000. How do you treat it? That's also an input VAT. Then we have salaries and wages. Salaries and wages. Do we have VAT on salaries and wages? VAT is exempted. Salaries and wages are exempted from the tax. Then we have what we call the legal services. Legal services. Legal services, how do you treat? That's an input VAT. Then we have stationery. 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 How do you treat the stationery? That's an input VAT. So then we have the next, what we call warehouse rent. Warehouse rent. Warehouse rent. That is also an input VAT. Then we have what we call security services. Security services. Security services. That's an input VAT. Then lastly, purchase of computer called partner limited acquired 75% of the ordinary shares of the company, which is called Soma Limited, on 1st July 2021. 1st July 2021. Then we also given that other information in paragraph 1. We will come back there when computing maybe the goodwill and also preparing what is required in part B. Okay, then let's go to note number 2. And you're told on 1st January 2022, Pata Limited entered into a joint arrangement with another entity to establish a joint control over the net assets and the operations of Jana. So remember, a joint arrangement is whereby a company will acquire 50%. Is whereby the parent company will acquire 50% of the share. So we are told this company, that is Pata, entered into a joint arrangement, and that is specifically on 1st of January 2022, to establish a joint control over the operations of Jana Limited. So mean that this company acquired 50% of the shares issued by Jana Limited on which date? On 1st January 2022. 1st January 2022. So we have that information. And then can we first of all go to note number 3? In note number 3, we are told on 1st January 2024, Pata Limited acquired an additional 30% shareholding in Jana for a cash consideration of 500 million. So during the current year, that is on 1st January of 2024, we are told that this company acquired additional 30% of the share in Jana, meaning that this company therefore was able to acquire the control. So the control was basically acquired on that particular date. And therefore, if you can be able to recall what we said, is that in case of a piecemeal acquisition, because this is a piecemeal or stage acquisition, the parent company has acquired the control over Jana through several purchases of shares. We say that we compute the goodwill on the date the parent company acquired the control. So the goodwill in relation to this company will be computed on that date, the date the parent company was able to acquire the control. But basically, before we compute the goodwill as required in part A and part B, that is in part A Roman 1 and also Roman 2, first of all, I want us, we prepare what is required in part B, and then we go back to part A. So we said even in an examination set up, no problem with starting with part B, provided your labeling is clear. The person who is marking your paper can be able to see that you started with part B, and then you did part A. You did part A after part B. So we start with part A, that is part B.
whereby we are required to prepare the consolidated statement of a profit or loss, and other comprehensive incomes, which is for the year which ended 30th of June 2024, 30th of June 2024. And I hope you can also be able to see our figures there. They are given in million of shillings. So we just need to have a single column here. A single column, and our figures are in million of what? Of shillings. We said even before we proceed to prepare this, it is important for us to determine whether there was any company which was acquired during the current year. So like the first company here, that is Soma, you can see the date it was acquired. It was acquired back in 2021. So we are required to prepare this one for the year 2024. So automatically what that means is that we, when preparing our consolidated statement of profit or loss, we will take the revenue and expenses for this subsidiary for the whole year. For the whole year. For the whole what? Year. It was acquired back in 2021. The parent company had a control over this subsidiary for the full year. So, but now this one, that is Jana, you can see the parent company acquired the control on which date? This date here. That is 1st January 2024. The year is ending 30th of June 2024. So the year started here on 1st of July 2023. So how many months do we have here? Basically here we have 6 months, because we have July, August, September, October, November, and December. And then here we have 6 months. So here we have 6 months. Here we have 6 months. Now, in the first 6 months here, our parent company had a shareholding of what? In Jana. So our parent company, before acquiring this additional 30% of the shares, the parent company had what? 50% what? Shareholding. So if that is the case, then this company for the first 6 months, it was a joint arrangement, or basically it was a joint what? Venture. And then on this date, the parent company acquired an additional 30% shareholding, meaning that in the last 6 months, the parent company had 80% shareholding in what? In Jana, meaning that Jana for the last 6 months here, it was what? It was a subsidiary. It was what? A subsidiary. That information is very important when it comes to the preparation of our consolidated statement of profit or loss. So this can mean that in preparing this, we are going to take the revenue and expenses of the parent, that is Pata and Soma for the whole year. We combine them. And then for Jana, we will only take the revenue and expenses for 6 months, because it was only a subsidiary for 6 months. Then for the time it was a joint venture, we will compute something called the parent company share of the joint venture profit after tax. Sasa? Yes. So let's do that here. I want us to go back to the statement of profit or loss for individual company given below paragraph 1. And basically, we will start with the revenue. So we take the revenue of the parent, which is Pata for the whole year, 7550. For this one, that is Soma for the whole year, which is 4260. And then for this one, that is Jana, we will only take revenue for 6 months. It was a subsidiary only for 6 what? For 6 months. So we take half of that value. What is half of 2860? Half of 2860. Half of 2860 is what? Is 1430. Is 1430. And then we say, make sure this figure by the end of the day, you get it correct. Because we say the only adjustment affecting this is any sales between the parent and the subsidiary. So we will check whether we have that as we go through the additional information. Then from there, we have the cost of sales. We do the same. The full amount for the parent, that is Pata, Soma for the whole year, and basically for Jana, half. Half, that will be 740. Then from there, we will get the gross profit. Now, before we proceed to less the expenses, remember This particular company here, that is Jana, for the first 6 months, it was a joint venture. It was a joint venture. So what do we need to include here? As far as the joint venture is concerned, we need to include something called the group share. We add the group share of joint venture, or basically we can just refer to it as, yes, let's just refer to it as joint venture. Joint venture, profit after tax. So let's go to the income statement of this company here. From the income statement of Jana, how much was its profit for the year? The profit for the year for Jana from the income statement. Profit for the year for Jana, can you see that value? Yes, it is 500. So the first thing we need to do is, because this is the profit for the whole year, we want to compute the profit for the first 6 months, apportion that on time basis, and then get the parent company share of that. The parent company share will be 50%. 50%. So we get half of this, which is 250, and then half of 250 will be 125. Remember, you said these items do not have any adjustment. So having said, we can then proceed and realize the expenses. The first expense we have there is the distribution cost. And I hope you can always remember that this is a free mark in any question for group account. In any question for group account, this one do not have any adjustments. So we have 495 plus that of the subsidiary, that is Homa, which is 290, plus half that of Jana, which is 100. That one, we cross the bracket, and actually we take the figure to the last column here. So I'm told this will give us 885. 885. And take into account is an expense. Remember to record it here as a negative. This one is an income. We record it here as what? As a positive. Are you getting that value? 885. Are you getting 885? Maureen, are you getting 885? Faith, are you getting 885? Are you getting 885? 885, yes. Okay, so below that we have administrative expenses. The administrative expenses, we do the same. We take that of Pata 760, that of Jana 650, and half. Okay, that of Soma 650, and half that of Jana, which will be 200. So mostly we say that this one is adjusted with the amount of impairment loss. And then from there, we will get the profit from operations. And then to this, we less the finance cost. Finance cost, we do the same. We take that of the parent, 90, that is Pata, that of Soma, 80, and half that of Jana, which is basically 30. So then from there, we will get the profit before what? Tax. And then to this, we less the income tax expense. Income tax expense is the other free mark here. So we take that of Pata, the 40, plus that of Soma, plus half that of Jana, which is basically 110. We close the bracket, we get the final value there. We get the final value. We get the final value there, which I'm told is what? Which I'm told is 820. 820. 820. Are you getting 820? 820. So that will be the profit after tax. The profit after tax. The profit after tax. The profit after tax. I need a confirmation whether that figure is correct. Are you getting a figure of 820? Okay, yes. So then below that, we add other comprehensive income, OCI. OCI, we have the gain on property devaluation. We have the gain on property devaluation. So in this case, we should take that of the parent, which is 265. And then for the other company, that is Homa, equally for the whole world, for the whole year. That's yes. And then for the other company, you can see that is Jana. That company is not having any revaluation reserve. So meaning that equally this one do not have any adjustment. In case you come across this, unless maybe you have a revaluation gain for this, that is the only revaluation gain which requires some working. But I think in our case, these two will not be having any working. So we just get the final figure of 340 what? 45. 345. So you can see basically that question, even without having dealt with the note, you should be able to get some free marks here. You should be able to get some free marks here. Some free marks there. Now, before we compute the goodwill, I want us to go through the additional information, and basically we see which items need to be adjusted here. We will start with note number 1. Let's go back to note number 1, additional information number 1, and specifically in additional information number 1, we go to paragraph 2. Paragraph 2. In paragraph 2, we are told at the date of acquisition, the fair value of the identifiable net asset approximated their carrying values with an exemption of an item of plant whose fair value exceeded the carrying amount by 600 million. So automatically that is a revaluation gain. That is a revaluation gain. That is a revaluation gain by which company? This is a revaluation gain by this company, because whatever you're given in note number 1 is about acquisition of Soma here. So Soma Limited, on the date of acquisition, it revalued the assets. There was a revaluation gain of how much? Of 600 million, because we are told the fair value of that asset exceeded the carrying amount. So 600 million is a revaluation what? A gain. So we are told the plant had a remaining useful economic life of how many years? 6 years. So who can tell us what do we need to compute as far as this revaluation gain is concerned? What do we need to compute here? As far as this revaluation gain is concerned, what do we need to compute? What do we need to compute? Specifically, I'm told by this, we need to compute depreciation. The specific name for that, once the subsidiary company revalues the asset on the date of acquisition, what do we compute? We compute something called what? The depreciation other charge. The depreciation what? Other charge. Depreciation other charge. So how do we compute the depreciation other charge? We take the revaluation gain, 600 million. We divide that with the remaining useful life. We are told there are 6 years. And then we multiply that with the proportion of time. Remember, in our case, what we said that when computing the depreciation other charge to be adjusted here, we compute the depreciation other charge for the current year only. So in our case, remember, this company was acquired like how many years back from this date? So, or basically, how many years do we have from the date this subsidiary was acquired to the date of consolidation? So the first year ended 2022, 2023, 2024. So in this case, if, for example, we were preparing the consolidated statement of financial position, you multiply this with 3, such that you get depreciation other charge for 300 million. This one should be deducted from the PPE. But when preparing the consolidated statement of profit or loss, we only consider the depreciation other charge for the current year only. The depreciation other charge for the current year only is how much? Is 100 million. Is 100 what? Million. So what we consider here is depreciation other charge of 100 million. And what are we told there? Are we told how the company accounts for depreciation? No. In this case, we say this, the question is silent. Any depreciation other charge should be added here. Should be added to the group what? Cost of sales. Should be added to the group cost of sales. So we are done with that. So, but also remember, when computing the goodwill on acquisition of this subsidiary, this 600 million is a pre-acquisition revaluation reserve. So we're going to use it in the computation of what? Of the goodwill. When computing the goodwill, that will be one of the pre-acquisition revaluation reserve. Okay, so we have that. So then let's move to point number 2, and we are told on 1st January 2022, Pata Limited entered into a joint arrangement with another entity to establish a joint control over the net assets and operations of Jana. Pata Limited acquired 50% of the ordinary shares of Jana Limited for a cash of 700 million when the retained earnings of Jana amounted to 1,300 million. Pata Limited equity accounted for its share of interest in Jana Limited in line with the International Accounting Standard number 28, investment in associate and joint venture. And then in note number 3, so as far as note number 2 is concerned, there is nothing which will be affecting our consolidation or no a consolidation adjustment we need to make here as far as note number 2 is concerned. Sasa, what about note 3? We are told on 1st January 2024, Pata Limited acquired 30%, or that is additional 30% shareholding in Jana for a cash consideration of 500 million. The fair value of the original investment as at 1st January 2024 was 950. All that information, we are going to use it in the computation of goodwill arising on acquisition of this. So that information, we are going to use it in the computation of goodwill. And then you're told no fair value adjustment was necessary in respect of the identifiable net asset of whom? Of Jana. Sasa. So no consolidation adjustment we are going to make to this in relation to note number 3. In note number 4, you're told the group policy is to measure the non-controlling interest in subsidiary at their proportionate share of the net asset. So this is basically to guide us in terms of knowing which method to be used in the computation of goodwill. Automatically, we said, as per that note, we are going to compute the goodwill using the partial goodwill method. Number 5, we are told, during the year which ended 30th of June 2024, Pata Limited, which is our parent, sold some goods to Soma. Sold some goods to Soma Limited at for shilling 340 million fair value. So that is basically amount of intra-group trading. So that one should be deducted here, 340, and also should be deducted here. 340. And then you're told Pata Limited reported a loss of 550 million from this transaction. There is something we are going to change because I think there is some explanation which are given in relation to that note in our previous class. There is something we are going to change from that explanation which I gave. But maybe first of all, let's go through the entire statement, and then I'll be able to correct the explanation which I gave in our previous class. So we are told this company which sold the goods, that is Pata, reported a loss of 55 million on the transaction. 55 million on the transaction. Then we are told Soma Limited still had a half of these goods in its inventory at the end of the year. Now, if you can be able to recall what I said in our previous class, because this company sold some goods and basically made a loss of 55 million, I said that you need to compute something called the unrealized loss, which we said should be half of this. And I think that was coming to 27.5. Is that the position? Yes. But basically what you need to know is that if the parent company here sells some goods to the subsidiary, that is Soma, the goods were sold by this company at 340 million. So this 340 to this company is basically a selling price. If I sell some goods to you, maybe at 340 million, to me is a selling price. What about to you? That 340 will be what? In your books of account. Whenever you're recording that in your books of account, put that 340, is it still a selling price? Or is cost? The 340 in your books of account, is it a selling price? Is it a cost? I've sold some goods to you, maybe having a value of 340 million. I'm saying in my books of account, that is a selling price. That is a selling what? Price. What about in your books of account? In your books of account is a cost. In your books of account, that is what? That is a cost. That is what? The cost. Now, if you can be able to remember now what you have been doing in all the other questions for group account, usually we come across questions whereby we compute the unrealized profit. And actually, I say that the implication of this unrealized profit is that it overstates the closing inventory of this. So if, for example, this company sold some goods now to this, and this company made a profit, we say that this and this profit usually overstate the closing inventory of this. Are we together? Yes. And that's why we say any unreleased profit should actually be deducted from the closing inventory, simply because the inventory of this company is actually overstated. Is actually what? Overstated. But now, if you come across this particular question, and basically you're told the selling company sold the asset or even some goods at a loss, sold the goods at a loss, the goods at what? The goods at a loss, then in this case, when preparing the group accounts, we always ignore that what? We ignore that loss. We ignore that what? Loss. In that case, we will not compute the and realize what? Loss, like basically what I've explained in our previous class. Because if we do that, we will come and maybe adjust it in the closing inventory. And actually, you can see the closing inventory we have said is valued at cost. Is valued at what? At cost. But basically, let's not go into details about that. What you need to note that if we are told the goods or the selling company sold some goods and made a loss, so in that case, always ignore that particular word, loss. That's that. So you will only make an adjustment whereby the goods were sold at a profit. So if the goods were sold at a profit and some of the goods remain unsold at the end of the year, that is the only time you compute them, and it is what? A profit. And actually, we know that this profit, number one, we add it to the group cost of sales and we less it from the group inventory. But in case the goods were sold at a loss, that is something you need to note, was sold at a loss, basically ignore that loss. And I'll say that this is based on IS2, because if we will account for that particular unrealized loss, then the value for the closing inventory will be reduced below the cost, will be reduced below the cost. Remember, according to IS2, we should always value the inventory at the lower of the cost or the net realizable value. Sasa? Yes. So that loss, we ignore it. We do what? We ignore that loss. It will not be adjusted to the cost of sales. It will not be adjusted to the group inventory. In case we are to prepare the consolidated statement of financial position, we don't adjust that to the group inventory. Sasa? Yes, that note is important. So we are done with that. So and then number 6, we are told impairment review on 30th of June revealed that the goodwill on acquisition had not suffered any impairment. So we said if you come across that information, you need to come back here and you cross that bracket. No adjustment to the administrative expense, because usually we see that this one is adjusted with the impairment loss. So we can get the final values here. The final value will be how much? 7 what? 760 plus 650 plus 600 plus 200 plus 200. That will give us what? That will give us 16 what? 1610. And we said make sure you record that there as a negative. You record it there as what? As a negative, because that one is an expense. So, and then you are told number 7, all other incomes and expenses of the group are deemed to have accrued evenly throughout the year. So the reason why always you're given that information is for you to know that when taking or when computing the revenue and expenses of JANA for the last 6 months, when it was a subsidiary, you are basically going to apportion that on time basis. And that's specifically what you have done here. Is there anything which need to be adjusted here? I think no. So what we can do, let's get the final values, and then we go to the statement, or basically we go back to Roman 1 and we compute the goodwill on acquisition. So we start with the revenue. Give me the final value for the revenue. The final value for the revenue here. The final value for the revenue, I'm told by Gilbert, it is 13,100. What about the cost of sales? The cost of sales, 79 what? 30. 79.30. Is that what you're getting? 79.30. 79.30. Please confirm. 79.30. 79.30, is that what you're getting? Confirm whether you're getting that value there. 79.30. Yes, yes. Then in this case, we said, for example, if you're doing this question in an examination, I'll not even advise you to compute that one. You see that gross profit, we said by the end of the day, that is not marked. Any figure which you get after adding or basically after deducting, do not have any mark. No mark for that. No mark for, no marks for that. No marks for that. For that there. Yes. So then from there, we have the final value for this one, the group share of joint venture profit after tax. We have the distribution. We have this profit of from operation. No need of even computing that. Can we get the finance cost? The finance cost is going to be 170, 200. Remember to record it as a negative. Remember to record it as a negative. To record it as a negative. Yes. So no need of computing this. No need of computing that. No need of computing that. No need of computing that. Now, if you do that question like that, you'll have gotten all the marks. For example, if you check, I was trying to check on the solution for this question here. If you check on how it was marked this particular question here, basically the marks are located. I don't know whether you can be able to see that. You can't be able to see that, but basically this is how the question was marked. Any 7 at 2, and you get 14 marks. The marks are located there were 14. You needed to get 7 items, 7 correct items, 7 correct items. You get the 14 what? Marks. That's why we say these particular items you get 3 marks. They are very important because you can see if you get this one correct, and even this one, because that one do not have any adjustment, distribution, and basically the income tax, you can see those are like 4 items. Those are like 4 items. You need to get 3 other items. So, and actually you can see also this one did not have any adjustment. The finance did not have any adjustment, including what? Including the administrative. Including the administrative what? Expense. You can see that is a question here, which was maybe quite simple. Even if, for example, maybe you adjusted this particular and there is loss, maybe you adjusted here. Equally, you can see maybe the only item which was long would have been long is this one. Sasa? Yes. So I think having that, I want us to go, we proceed and basically we compute the goodwill on acquisition. The goodwill on acquisition, the goodwill on acquisition, goodwill on acquisition. And I want us to start by computing the goodwill on acquisition of this subsidiary here, that is Soma, goodwill on acquisition of Soma Limited. Soma Limited, the marks are located, there were 2. I think that one was quite simple. And remember, this goodwill will be computed using the partial. We are computing this using the partial goodwill method as per the information which are given in note number. As per the information you're given in note number 4, we are using the partial goodwill method. So how do we compute this? The goodwill using the partial goodwill method. We start with the purchase consideration paid by the parent. Purchase consideration, which was paid by the parent company. This one is in note number 1. Note number 1. Let's go to note number 1. Note number 1. We are told on 1st July 2021, Pata Limited acquired 75% of the ordinary shares of Soma for a cash consideration of 4,500 million. So the cash consideration paid by the parent was 45. So and then now to this, we do what? We less the fair value of net assets acquired. Fair value of net assets acquired. Now, how do we compute this one? We say to compute the fair value of the subsidiary company net asset on the date of acquisition, we take the subsidiary company ordinary share capital plus the pre-acquisition reserves. Now, where do we have the ordinary share capital? So below the information below paragraph 1, we have the statement of profit or loss, and then down there, we have the extract of the equity section. So what are we interested with here? We're interested with the ordinary share capital of who? Of this subsidiary, that is Soma. So we go to the equity section of Soma Limited, and the first item we consider here is what? Is share capital. Share capital share, which is 500. So then below that, we have the revaluation reserve. We have the revaluation reserve. The revaluation reserve. The revaluation reserve. So this revaluation reserve, we need to determine, is it pre or is it post? Is it pre or is it post? Based on the information which are given here. So that revaluation reserve by Jana, not Jana, sorry, by Soma. By Soma. It is also important for you to check the date. The date there. So that equity balances, they are at the end of the current year, on that year of June 2024. Now, what I'm asking, this revaluation reserve, which we are given here of 80, is it pre-acquisition? Is it post-acquisition? Who can tell us? I'm told by this is post-acquisition. Is this post or pre? Is this post or pre? And also take into account, can you go back to the income statement of Soma? In the income statement of Soma down there, we are also given other comprehensive income. We know that Soma during the current year revalued assets, and there was a gain on property revaluation of 80. So automatically that revaluation gain in the income statement of Soma is a revaluation gain which occurred during the current year. Remember when Soma was acquired? Soma was acquired 3 years back. So therefore, that revaluation reserve, is it a pre or post? A pre or post? A pre or post? Automatically, this one is post because it is for the current year. Since it's for the current year, yes, it is for the current year. That amount of 80, and actually it is the one which is in the income statement. It was for the current year. So that is a revaluation gain of Soma after it was acquired. Do we consider that here? No, because what we consider here is the ordinary share capital of this plus the pre-acquisition reserves. So that one will not be considered here. That one is a post. And then down there, we are given the retained profit brought forward and the profit for the year. I think for Soma, what we need to do, if you go back to the information we have in note number 1, we must be given its retained earnings on the date it was acquired. Yes, Abuche, we're going to consider that one in note number 1. I'm still where we have those the equity section. So we will go back to note 1. Sasa? Yes. So because that it has nothing to do with the revaluation gain we have in note number 1. Now I'm saying if you go to note number 1, you'll be able to see the first sentence or the first paragraph. We are given the retained earnings of Soma on the date it was acquired. Can you see the retained earnings of Soma on the date it was acquired? Because that's what we consider here. We consider the retained earnings of the subsidiary on the date it was acquired, on the date of acquisition. Can you see that amount? The amount of 21. Yes, that is basically what we consider here. That is what we consider here. The retained earnings on the date of acquisition. Automatically, the reason why you're given that breakdown, the retained earnings at the start, the retained earnings for the year or the profit for the year is for us to be able to compute the retained earnings of Jana on this date. Sasa? Yes. So, but for Soma, we are given its retained earnings on the date it was acquired. So, do we have anything else to be considered here? Yes. We said always when computing this, we need to check whether the subsidiary company valued the assets on the date of acquisition. If it valued assets on the date of acquisition, any revaluation gain is considered here as part of pre-acquisition. And in note number 1, when Soma Limited was acquired, it revalued assets, and there was a revaluation gain in paragraph 2 of note 1 of 600 million. So that revaluation gain of 600 million, this one was not accounted for. and it is a pre-acquisition. It was not accounted for, and it is what? A pre-acquisition. I think that basically what we have. I don't think we have any other component of our net asset. So what we need to do here is we get the total. So let's get the total here. Give me the total value. 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 What are you getting here as the total? What are you getting as the total here? What are you getting as the total? The total is basically 32. 32. So 32, we are using the partial goodwill method. So under the partial goodwill method, we're interested with the net asset of who? We're interested with the net assets acquired by who? By the parents. 75%. 75 what? Percent. 75%. So what will be 75% of 32? 75% of 32, it will give us what? It will give us 24. So we get the difference here, which now will be the goodwill, which will be the goodwill, and that is 21. Is it 21? Yes, 21. So basically that, what was the required here? And for example here, what is marked? What is marked here? What will be marked is this. By recording that cash consideration, you have a mark there. Recording this is a mark, that and that. That is basically what is marked. Let me see, for example, how many or how the marks were located here. How are the marks are located here? How the marks are located here? Yes, this is how it was marked. Any 2 at 1. If you get, for example, that cash consideration in the share capital, you already have the 2 marks with you. Sasa, it's not a must. You get the final figure correct there. You get the goodwill as you get this figure to be correct. So you just need to get 2 correct items. 2 correct words item. That and that will give you 2 marks. So let's move and compute the goodwill on the acquisition of this other company. But now you need to note that the goodwill on the goodwill on acquisition of Ghana, the computation of this is quite complex because we are computing the goodwill arising from piecemeal acquisition. The goodwill arising from piecemeal what? Acquisition. And actually, we say the computation of that is quite different. It's quite different from how we compute the other goodwill. So let's compute the goodwill on acquisition of Ghana. On acquisition of Ghana, I think I can have that working here. The goodwill on acquisition of Ghana. On acquisition of who? Ghana Limited. Remember this one, or basically this, the parent company acquired the control of Ghana through several purchases of shares. So how do we compute the goodwill arising from piecemeal acquisition? We said always we start with the costs of additional investment. The cost of additional investment. Initially, the parent company had acquired 50% shareholding in Ghana, and then later on acquired 30% shareholding. So this 30%, additional 30% which were acquired, we refer to that as what? Additional investment. So how much amount was paid? How much amount was paid? So we have that here. And then to this, we add the fair value of the original investment. The original investment is 50% shareholding. So what was its fair value on the date the parent company acquired the control? That is something always would be given. But equally, we said, if, for example, we were using the full goodwill method, we come and we add the NCI at fair value. We add the NCI at fair value in case we are using the full goodwill method. But remember here, we are using the partial goodwill method. So let's first of all record these two values. The cost of additional investment. So when the parent company acquired this additional 30% of the shares in Jana, how much amount was paid? That information we have it in note number 3. That information we have it in note number 3. That information we have it in note number 3. So the cost of additional investment, the cost of additional investment. The 30% shares were the parent company paid how much? Yes, in note number 3, you're told on 1st January 2024, Pata Limited acquired additional 30% shareholding in Jana for a cash consideration of 500 million. So that is the cost of the additional investment. Then in the same point, we are also given this one. So we are told that we are told the fair value of the original investment in Jana on 1st January 2024 was 950. So the fair value of the original investment was 950. Was 9 what? Was 950. Was 950. Now, but if you go back to the information, can we go back to the information which you're given in note number 2? In the information you're given in note number 2, you're told on 1st January 2022, Pata Limited entered into a joint arrangement with another entity to establish a joint control over the net asset and operations of Jana. And then you're told Pata Limited acquired 50% of the ordinary shares of Jana for a cash consideration of 700. So you can see this 50% shareholding, which was acquired back in 2022, was acquired at a cost of 700 million. So that is on 1st January 2022. But on this date, that is on 1st January 2024, the fair value of this, or basically this investment, was fair valued at how much? At 950. So it basically means that we have an increase in the fair value of this 50% investment. So how much is the increase here? How much is the increase in that? The increase in the value for that investment is basically 250. Now, how do we account for this? How do we account for that increase in the value of an investment in a company? So how do we account for that? How do we account for this? There is another question which we did similar to this one, and I was able to explain how we account for that. How do we account for this 250, which is the increase in the fair value of 50% shareholding in Jana? How do we account for this? Who can be able to remember? Who can be able to remember? Who can be able to remember? Who can be able to remember how we account for this 250? Who can be able to remember? Who can be able to remember how we account for this? Yes? Who can be able to remember? There is a similar question which we did, and I think I was able to explain how we account for this. Who can be able to remember how we account for this? Yes. So basically, this one we said that it should be recognized actually as part of OCI. As part of what? OCI. So maybe in that consolidated statement of profit or loss which you have prepared here, you basically recognize it as part of what? OCI. As part of what? OCI. So though that will not be affecting now this one. So can we first of all get the total here? This will give us a total of what? 1450, yeah? 1450. After adding those two values, are you getting 1450? 1450? If yes, yes. So then now to this, what do we less? We less the fair value of our net assets. Fair value of net assets acquired. Fair value of the net asset acquired. It's also important for you to remember we are computing the goodwill on acquisition of this subsidiary on this date. We compute the goodwill on the date the parent company acquired the control. That's why we are taking For example, the amount which was paid on the parent, or basically the amount which was paid when the parent company was able to acquire the control, how much amount was paid for the additional 30% shares which were paid, and what was the fair value of the original investment on this date. We compute the goodwill on this date, the date the parent company acquired the control. So also it means that we are going to less the net assets which were acquired specifically on this date. So how do we compute the net asset of Ghana Limited on this date? So we will take the ordinary share capital of Ghana, and then we will add the pre-acquisition reserves, or basically the reserves which Ghana Limited was having on that date. On that what date? So let's go to where we have the equity section of Ghana, and the equity section of Ghana is given below the statement of profit or loss. So the ordinary share capital of Ghana is 300. 300. So Ghana Limited do not have any devaluation reserve. I hope you can see that. So then in this case, we need to compute the retained earnings of Ghana specifically on this date. That's why you can see in that case, we are given the retained earnings of Ghana at the start of the year, that is brought forward, which is at the start, and also for the year. For you to be able to compute the retained earnings of Ghana specifically on this date here. On that what date? So how do we compute the retained earnings of Ghana on the date the parent company acquired control? So maybe you can have that here, because you're given the retained earnings brought forward. So the retained earnings brought forward is the retained earnings at the start of the year, and that is 1450. So remember, you're interested with the retained earnings here. How do we compute the retained earnings here? Remember, you're given the profit for the year. The profit for this year is 500. Is 500. So how do we compute the retained earnings of Ghana specifically on this date? And that one is quite simple. We will take the retained earnings at the start, this one, 1450, and then to that we take the profit reported by Ghana for the whole year. We basically compute how much profit was reported by Ghana here before it was acquired. Remember, you have 6 months here, so we apportion that on time basis. We multiply that with 6 all over 12. So that will give us 1450 plus half of this, 250. That will give us what? That will give us 1700. 1700. Are you getting 1700? 1700. 1700. 1700. Are you getting 1700? Yes. So 1700. 1700. And maybe you can also check whether the subsidiary company devalued the assets on the date the parent company acquired the control. I think there is some information which you're given in relation to them. In note number what? In note number 3, the last sentence, we are told no fair value adjustment were necessary in respect of identifiable net asset of Ghana. So when the parent company acquired the control, this company did not devalue the asset. That's that? Yes. So there was no revaluation gain. So we need to get the total, and basically this one will give us what? Will give us 2,000. Will give us 2,000. And because you're using the partial goodwill method, we are interested with the net asset acquired by the parent. The net asset acquired by the parent will be 80%. Will be 80%, this one. 80%. 80% of this will give us what? Will give us 1,600. Will give us 1,600. Will give us 16 what? 1,600. 1,600. So what we need to do is we get the difference. So this minus this one, and that will give us what? That will give us negative what? 150. Negative 150. What is the name given to that? What is the name given to that value of 150? That 150. The name given to that 150? Maureen, Faith, what is the name given to this? Mike, Patrice, the name given to this? Diana, Georgina, the name given to this? That negative 150. The name given to that figure there. That 150 is known as what? And I hope you can see the negative. Or we are wrong? No, we said whenever you're computing goodwill, you can get a positive figure, you can get a negative figure. We said if it's a positive figure, it's a goodwill. But if it's a negative figure, what is that? Yes, you can't remember the name? We say that if you get a negative figure here, this one is known as a gain on bargain purchase. A gain on bargain purchase. A gain on bargain purchase. Gain on bargain what? A purchase. And actually, we say that this gain on bargain purchase, we recognize it in the income statement as part of other income. So therefore, what you'll do from this consolidated statement of profit or loss which you have prepared, below the gross profit, can you include that gain? Can you include that gain on bargain purchase? Gain on bargain purchase. So this one we recognize it as part of the other incomes. An amount of how much? An amount of 150. An amount of what? 150. That's that? Yes. So if you get a negative figure down there, that one is a gain on bargain purchase. But if you get a positive figure, we say is what? Is a goodwill. Is what? Is a goodwill. So basically that is it, that what was required in that question. So what is marked here? What was marked there in relation to that Roman 2? So the items which were marked were this one, this, and that, and that. Yes. And basically, actually this one was, there are two marks for, two ticks for that because of this, because this was marked, there was a mark for that and this one, So, and any 4 at 1, any 4 at 1. So it basically means that it's not a must you get the final figure correct, provided you can be able to get that, and maybe some few items there. For every correct item which you get there is 1 mark. Is one what? 1 mark. So that is it. That basically what is required as far as that question is concerned. A very good question on a piecemeal acquisition. A very good question on piecemeal what? Acquisition. On a piecemeal acquisition. Okay, so I think we will take a short break. We will take a short break, and then once we come back, we look on something else. We look on something else after the break. After the break. Yes, so as we come back, can you have this question with you? This one, May 2021, which is question number 2. Not question 2, Lala, question 1. Question 1 is still a question on piecemeal, but let's look on that after the short break of just 5 minutes. 5 minutes, we come back. So we are told the following draft statement of financial position relates to P Limited, S Limited, and R Limited, all public companies as at 30th of June 2020. So we have the statement of financial position for P, S, and R, the non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information number 1 all the way to note number 6. So what are we required to do here? We are required to compute the goodwill on acquisition of S and also R, and then we are required to prepare the consolidated statement of financial position, consolidated statement of financial position. So the first thing we need to do here is basically to come up with a group structure. To come up with the group structure. So where do we have that information? The information is given in the additional information. So in note number 1, you're told on 1st July 2018, P Limited acquired ordinary shares of S Limited, or acquired 80% of the ordinary shares of S Limited. So this company, which is called P Limited, we are told acquired 80% of the ordinary shares of the company, which is called S Limited, on which date? On 1st July 2018. So this is the parent, is a subsidiary. And then we also given other information here about the revaluation of assets. Maybe first of all, you can skip that. We go to note number 2. We are told on 1st July 2017, P Limited had acquired 5% of the ordinary shares of R and treated this as an investment at fair value through profit and loss in the financial statement. To that year of June 2019. On 1st January 2020, P Limited acquired a further 55% of the ordinary shares of R and gained a control. So this company initially had acquired 5% shareholding, and this 5% shareholding in R was acquired on which date? Was acquired on 1st July 2017. And then you're told later, that is on which date? On 1st January 2020. 1st January 2020, this company acquired a further 55% shareholding, and therefore it was able to acquire what? A control. Because you can see by the end of the day, P Limited will be having a total shareholding equivalent to 60%. So this is a piecemeal or a stage acquisition. Now, having said, what are we required to do here? Maybe we start with part B before we come back to part A to compute the goodwill. In part B, we are required to prepare the consolidated statement of financial position of P Group. Now, we said in preparation of that, in preparation of the consolidated statement of financial position, because this one is prepared as at the end of the year, that is as at that year of June 2020, we basically need to determine the status of S and R at the end of the year. So automatically this one will be a subsidiary at the end of the year, and equally this one will be a subsidiary, because you can see on this date, 1st January 2026 month to the end of the year, the parent company acquired the control. Still at the end of the year, this one will be a subsidiary. So if it is a subsidiary, it basically means that in preparing what is required in part B, we are going to combine similar items of asset and liabilities of all these companies, P, S, and also what? R. But it's also important, maybe, for example, if you're doing this question in an examination setup, it is important maybe you go through what you're given in note 2, note 3, and note 4. Although note 4, there was the aspect of impairment. There was the aspect of impairment of assets, but maybe if time allows, we are going to look on that. So let's go straight to that. We go straight to that, what is required in part B. In part B of the question, first of all, we skip part A. So we are required to prepare the consolidated statement of financial position as at that year of June 2020. And basically, I've said we will prepare this one by combining similar items of assets and liabilities for all our companies here. So let's go to the information we have below paragraph 1. And basically, we have the non-current asset. We will start with the PPE. So PPE we combine for all the companies, 3920 plus 21 plus 910. We will see whether we have any adjustments. In addition to what you have below that, investment in S, investment in R, do we include that here? No. So instead, what we will do, we will compute the goodwill on acquisition of S and also the goodwill on acquisition of what? Of R. And basically recognize is an entity where the parent company, I hope you can also be able to recall that the parent company is called the investor company. The parent company or the investor company exercises something called significant influence. So when we talk about the parent company exercising significant influence, this basically means that the parent company is not in a position to control the operating and financial decisions made by the associate, or even to control its composition of the board of directors. But the parent company is able to influence the operating and financial decisions which will be made by the associate company. Now, a parent company, or basically an investor company, is said to exercise significant influence over the associate if the parent company has acquired shares which lies between 20% to 49%. If, for example, in this case, we are told 𝐎𝐍𝐿imited acquired shares which lies between 20% to 49% of the shares issued by 𝐉𝐿imited, it basically means that this company here will be able to influence the operating and financial decisions made by 𝐉𝐿imited. So this company is not able to control the operating and financial decisions of this, but it is purely able to influence. It is able to influence. So therefore, anytime you're given a question and you're told the investor company or the parent company acquired shares which lies between 20% to 49%, it automatically means that the investee company, this company here, is an associate. Is what? An associate. So that is basically the definition of an associate. And then from there we have the other entities here, and basically that is a joint venture. So when we talk about a joint venture, this is an entity in which the parent company and another entity acquire something called a joint control. So this is an entity where the parent company, and another entity acquires joint control. So in this case, when we talk about the parent company and the other entity acquiring a joint control, it basically means that assuming we have two companies, 𝐴𝐿imited and basically 𝐵𝐿imited, so this company may enter into an agreement to acquire equal shareholding or to acquire equal shares in maybe a company which is called 𝐶𝐿imited. So this company acquired 50% of the shares. The remaining 50% of the shares are acquired by 𝐵𝐿imited. So in this case, we say that these two companies have acquired a joint control in C. Joint control means that the operating and financial decisions of this company here, that is C, will be jointly controlled by A and B. So A and B will be jointly controlling the operating and financial decisions which are made by C. And therefore, this company here, we refer to this company as a joint venture. We refer to this particular company as what? As a joint venture. Now, having known what is an associate and basically what is a joint venture, the other thing we need to ask ourselves here, how does the parent company prepare the group account whereby the parent company has invested in an associate or invested in a joint venture? Now, the preparation of group account in this case is governed by this particular standard, which is International Accounting Standard number 28. And this particular standard requires that whenever the parent company has invested in an associate or basically invested in a joint venture, the group account, the consolidated financial statement should be prepared using the equity method. So the group account, in this case, we can say a group account, all the consolidated financial statements should be prepared using the equity method. So equity method basically is a method of accounting. And this particular method, how is it applicable in preparation of the consolidated income statement? How is it applicable in the preparation of the consolidated statement of profit or loss? So first of all, I want us we look on how this method is applicable when it comes to the preparation of the consolidated statement of profit or loss. So how do we apply this method? Now, number one, when the parent company has invested in an associate or basically a joint venture, and we are preparing this, we are saying we should be able to do that in accordance with the equity method. Now, this method requires one, when preparing this, similar items of revenue and expenses, those of the parent company and those of the associate or those of the joint venture should not be consolidated, should not be combined. Should not be what? Should not be combined. So if the parent company has invested in an associate, has invested in a joint venture, you are preparing this, the consolidated statement of profit or loss, we are saying use equity method. And actually, according to the equity method, we are saying don't consolidate similar items of revenue and expenses, those of the parent and those of the joint venture. Like what we are doing in case of an investment in a subsidiary. We said in our previous discussion, once the parent company has invested in a subsidiary and you are preparing this, you should combine similar items of revenue and expenses, those of the parent and those of the subsidiary. But in this case, we are saying we don't do that. So instead, what we include here, as far as the associate or joint venture is concerned, is the group share. The group share, loss associate, or basically joint venture, profit after tax, and other comprehensive incomes. Another comprehensive income. So what we need to do basically is to determine what is the parent company share of the profit after tax, and also the other comprehensive incomes, which were reported by the associate and also the joint venture, and then we include them within the consolidated statement of profit or loss. But in this case, we are saying never make a mistake of consolidating revenue and expenses, those of the parent, those of the associate, or those of the joint venture. Instead, what we include here is the parent company share of the associate or joint venture profit after tax and other comprehensive income. Then from there, let's look on how this method is applicable when it comes to the preparation of the consolidated statement of financial position. Consolidated statement of financial position. Consolidated statement of financial position. Now, first of all, recall what we said in our previous class. Anytime the parent company has acquired a subsidiary and you're required to prepare this one, consolidated statement of financial position, we said you combine, you add together similar items of assets and liabilities, those of the parent, those of the subsidiary. Is that what we do here? No. So according to the equity method, when preparing the consolidated statement of financial position and the parent company has invested in an associate or basically a joint venture, we don't combine similar items of assets and liabilities, those of the parent and those of the associate or those of the joint venture. So in this case, we can say similar items of assets and liabilities, assets and liabilities, those of the parent company and those of the associate or those of the joint venture, they are not consolidated. Not consolidated means that they should not be combined. They should not be combined. Like what we are doing in case of an investment in a subsidiary. Here we don't combine. Instead, what do we include here? What do we include in the consolidated statement of financial position as far as the associate or the joint venture is concerned? We include something called the investment in associate, or basically investment in what? In the joint venture. So we have to compute something called the investment in associate, or basically investment in what? Joint venture. And actually we include that, we recognize that as a component of non-current asset in the consolidated statement of financial position. So how do we compute this one? To compute the investment in associate or the investment in joint venture, we start with the cost of investment. So the cost of investment, basically, this is a purchase consideration which was paid by the parent company in acquiring the shares of the associate, or basically acquiring the shares of the joint venture. So how much purchase consideration was paid? And then to this we add the group share of post-acquisition retained earnings, and any other post-acquisition reserve. Any other post-acquisition reserve. So when we talk about the post-acquisition retained earnings, post-acquisition reserve, this refers to any reserve of the of the associate, or basically the joint venture, after it was acquired. So the retained earnings of the associate of the joint venture after it was acquired, or any other reserve of the associate or joint venture after it was acquired, or which must be a post-acquisition. So compute the group share of that. And then to this you less impairment loss. In most of these particular questions, you'll be told that the investment in associate or the investment in joint venture had impaired with a certain value. When talk about impairment of investment, this whereby you can invest your money in the company, but that investment loses value. You invested maybe by buying shares having a value of 200,000, but because the company where you invested has been making losses, it has not been able to pay dividends, your investment has reduced in value. The value of the shares you bought has lost some value. So that loss of value of the investment which you made in a company is called an impairment loss. The same case, the parent company may have invested in an associate or joint venture which has been making losses, and therefore you can be told the amount invested in the associate or the joint venture has lost some value. That is called an impairment loss, and basically we should deduct it here. Whatever we get here is basically what is known as the investment in what? In associate, or basically investment in joint venture. And basically this is the only item which is basically recognized. The only item which is recognized in the consolidated statement of financial position as far as the associate or the joint venture is concerned. We don't combine similar items of assets and liabilities, those of the parent and those of the associate, or basically those of the joint venture. Yes. So therefore, basically that's what you need to know. But if you can be able to recall what I said, is that most of the questions you will come across in the past papers, you'll be given three companies. You'll be given the parent company. You're told the parent company acquired a subsidiary, and also the parent company acquired an associate, or basically a joint venture. So you have three companies. Now you have to remember what we have discussed here. We have said in case the parent company has already acquired a subsidiary. So whenever we are preparing this consolidated statement of profit or loss, we combine similar items of revenue and expenses, those of the parent plus those of the subsidiary, those of the parent plus those of the subsidiary. In this case, I've said we don't include the the revenue and expenses of the associate here, So we don't consolidate the revenue and expenses, those of the parent and those of the associate or those of the joint venture. So you only combine for these two companies. So the same case, when preparing this consolidated statement of financial position, you are not supposed to combine to consolidate similar items of assets and liabilities, those of the parent, those of the associate, or those of the joint venture. So you should only combine similar items of assets and liabilities, those of the parent and those of the subsidiary. So we have said what you include here, as far as this associate or joint venture is concerned, is this item. You have to compute this item: investment in associate, investment in joint venture. That's what you recognize here. So here, what you recognize as far as this company is concerned is the parent company share of the associate or joint venture profit after tax and other comprehensive income. Other comprehensive what? Income. So basically, that is it. That's what you need to know as far as this is basically concerned. And I think with that, we can look on a question. I want us to look on a question on this. We look on a question on this, and basically from there, we should be done. So what will be remaining is for us to be able to do more questions on this. I want us to start with basically a simple question here. We can start with a simple question. So let's look on this question for August of 2023. Let's go to the question for August 2023. August 2023. So once you get the question, please confirm. August of 2023. And this is question number 3. That should be question number 3. 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 Yes, I hope you are there. I hope you have that question with you. Are you there? Yes, yes. So what are we told? What are we told here? So we are told that PICA Limited, a public limited entity, intend to expand its operation by acquiring investment in other entities. On 1st of November 2022, PICA Limited secured 75% equity interest in Shiba Limited under the following terms. Number one, you're told an immediate cash payment at a fair value of shillings 13 per share on 1st November 2022. Number two, an issue of 3 ordinary shares of shillings 10 per value in PICA Limited for every 5 shares acquired in Shiba. The fair value of PICA Limited shares was shillings 13 at the date of acquisition. The share issue has not been recorded by PICA Limited. So, and then you're told on the same date, PICA Limited also acquired 30% equity shareholding in Amua, paying shillings 24 million in cash. So then we are told the following draft statement of financial position as at 30th of April 2023 relates to PICA Limited and Shiba Limited. So we're given the statement of financial position for the two companies, PICA and Shiba. We have non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information number 1 all the way to note number 6. And then what are we required to do here? We are required to prepare on number 1 or part A to calculate the value of goodwill arising on acquisition of Sheba. From part B, determine the value of investment in 𝐻𝐻𝐶 Limited as at 30th of April 2023. And part C, we are required to prepare the consolidated statement of financial position of Pika Group as at 30th of April 2023. So before we do that, before we answer our question here, the first thing we need to do, number 1, is basically to come up with a group structure. We said anytime you come up, you come across a question for group account, the first thing you need to do is to come up with a group structure. Then from there, we will go through the additional information. We see, are there some workings which are required? So therefore, let's first of all, we come up with a group structure. So basically working 1 here will be the group structure. The group structure. So which information do we have about this? We are given information about the group structure within paragraph 1. We go back to paragraph 1, you're told, Pika Limited, which is a public limited company, intend to expand its operation by entering to expand its operation by acquiring investment in other entities. So we are told on 1st of November 2022, Pika Limited secured 75% equity interest in the company which is called what? Sheba. So we are told this company which is called Pika Limited, we are told secured 75% equity interest in the company which is called Sheba Limited, and we are given the date of acquisition, which is 1st November 2022. Remember, this is now the date of acquisition, the DOA. So we are given the terms of acquisition. Those terms, these are the payments which were made. We are going to compute that when answering part A of our question. And then in the last, there is the last paragraph down there where we are told on the same date. I hope you can see that paragraph. We are told on the same date. That is basically this date. We are told Pika Limited also acquired 30%. This company on the same date, 1st November 2022, it also acquired 30% equity shareholding in a company which is called 𝐻𝐻𝐶 Limited. 𝐻𝐻𝐶 what? Limited are paying shillings 24 million cash. It basically means that this company here, 𝐻𝐻𝐶, this will be an associate because you can see the shares acquired lies between 20% to 49%. This is basically an associate. So, but in this one, Sheba, this one is automatically a subsidiary company, whereas now Pika Limited will be our parent. So the company which should prepare the group account, we said is always the parent. The group account should be prepared by which company? The parent company. And basically now we have the dates of acquisition. Even before you move to computing maybe what is required, we said it is also important for you to be able to identify 2 dates. The 2 dates, the date of acquisition, which is abbreviated as DOA, and the date of consolidation, the DOC. The DOC is the date we are required to prepare the group account. So we can only be able to get this date in our requirement. When are we required to prepare the group account? Can we go to part C of that question? In part C of the question, we are required to prepare the consolidated statement of financial position on 30th of April 2023. So the date of acquisition here, you can see it is 1st November 2022. So what we need to determine here is, were these companies acquired in course of the current financial year? If you can be able to remember the question we did in our previous class, the question for 𝐻𝐻𝐶 and 𝐻𝐻𝐶, I hope you can be able to remember our subsidiary was acquired 5 years back. So, but in this case, you can see this subsidiary or these 2 companies look like they were acquired during the current year, because even year is ending April, the next year will start 1st May, that is 1st May. So it means that this year started on 1st of May, but 2022. So therefore, you can see this date of acquisition, it falls within the current year. So these 2 companies were acquired in course of the current year. So how many months do we have here? How many months do we have? So we can literally count. We have November, December, January, February, March, April, because that year is ending on April. How many months are those? 1, 2, 3, 4, 5, 6. So it basically means that these two companies, that is Sheba and Pika, they were basically acquired 6 months to the end of the year, 6 months to the end of the year. And we say this is very, very important, specifically when preparing the consolidated statement of profit or loss. If, for example, in our question, though that is not a requirement, if you are preparing, we are required to prepare the consolidated statement of profit or loss. In this case, we say we take the revenue and expenses of this company that is Sheba, basically for 6 months from the date it was acquired. So we take the revenue and expenses of Sheba for just 6 months by basically apportioning its revenue and expenses on time basis, and then we combine with that of the parent. But in our case, we are not required to prepare the consolidated statement of profit or loss. So therefore, it is important to note that these two companies were acquired 6 months to the end of the year. Now, having that, I want us to go straight to the additional information we see. There are some more things we need to do before we even answer our question. So in Roman 1, let's go to Roman 1, we see what you're told. So in Roman 1, you're told at the date of acquisition, the fair value of Sheba Limited, which is basically our subsidiary here, of Sheba Limited net asset approximated their carrying amount with an exemption of plant whose fair value exceeded its carrying amount by 10 million. So we said, if you see this, and we say this is something you'll come across in all questions for group account, the fair value adjustment, the fair value exercise, which we said is the devaluation of asset by the subsidiary company on the date of acquisition. So we said because the subsidiary company devalued the asset but never accounted for that, we said in preparation of group account, we make two adjustments, the revaluation adjustment and the depreciation adjustment. So we are told that the plant was valued and basically its fair value exceeded its carrying amount by 10 million. Then in the other paragraph, we are told the plant had a remaining useful life of 10 years at the date of acquisition, and then you're told the plant is being depreciated on straight-line basis. The plant is still carried at its carrying value in Sheba Limited financial statement. In other terms, it means that this company devalued the plant but never accounted for that. That's why it is still carried at carrying amount. In the last point of note 1, we are told no fair value adjustment was necessary on the acquisition of Amua. This company didn't devalue the asset. So in that case, what you're given in note 1 is something called the fair value adjustment or the fair value exercise, specifically by which company? By Sheba Limited. So in this case, we said we have to make two adjustments as far as this is concerned. The first adjustment, and this is exactly the same thing we did in the other question. The first adjustment is called revaluation adjustment. And actually, we said this is an adjustment which is made in relation to the revaluation gain or loss. So if you check on the information which are given in paragraph 1, this company Sheba did fair value adjustment. The net asset, the fair value of the net asset approximated the carrying amount with an exception of an item of plant whose fair value, that is what is important, whose fair value exceeded, the fair value was exceeded or was more than carrying amount. The carrying amount we said is also known as the net book value with 10 million. But if you check our figures up there, in our statement of financial position, our figures will be able to see them in thousands of shillings. We must also be consistent. We are going to work with all our figures in thousands of shillings. So this of the fair value of the plant was more than the carrying amount with 10,000 or with 10 million. So this one automatically is a revaluation gain. We said anytime the fair value exceeds the carrying amount is the revaluation gain. And because this revaluation gain was not accounted for by this company, we said this one will be added to the group PPE. This one should be added to the group PPE. And number 2, we say that this 10,000 is a pre-acquisition revaluation reserve. When computing the goodwill on acquisition of Sheba, this will be one of the pre-acquisition reserve we are going to use. So number 2, we make the other adjustment, which is called the depreciation adjustment. Depreciation adjustment. In this case, we said we compute something called the depreciation other charge, and that is depreciation other charge specifically by Sheba Limited. We compute depreciation other charge by who? By Sheba Limited. I hope you can be able to recall the formula which we use here. We said we take what? The revaluation gain, the exact thing we did in our question, in the other question, the revaluation gain. We divide that with the remaining UC price, and then in this case, we multiply that with the proportion of time. Proportion of time, of which we said proportion of time is basically the time we have from the date of acquisition to the date of consolidation. And I hope you can be able to recall here, that from the date of acquisition to the date of consolidation, I hope you can be able to recall we have how many months? 6 months. So these two companies, or actually Sheba was acquired 6 months to the end of what? To the end of the year. So this formula is what you need to remember always, is what we use in computation of what? The depreciation other charge. So therefore, to compute this depreciation other charge, we take the revaluation gain, which is this one, 10,000. We divide that with the remaining UC price. So what is the remaining UC price of this plant as per the information we have in note number 1? As per the information we have in note number 1, we are told paragraph 2, the plant had a remaining UC price of how many years? Of 10 years. Of 10 years. I hope you can be able to see that. Of 10 years. So that is the remaining useful life. And then we multiply that with the proportion of time. The proportion of time here will be 6 all over 12. 6 all over 12. That's basically how we compute the depreciation other charge. If you take on what you have done in this question, whatever we did in the other question is just the same. It's just the same. And basically I've said that this is an adjustment you'll come across in all questions for group account. In all questions for group account, you'll be told the subsidiary company on the date it was acquired, it revalued the asset. You must be able to record the adjustment which you make as far as that is concerned. So this will give us what? This will give us 1,000. A half of that is 5 what? 500. I hope you're getting 500. So this 500 will be adjusted in which two items? One, this one will be deducted from the group PP in preparing a consolidated balance sheet. And then we also deduct it from the retained earnings of this company. The retained earnings of this what? Company. Now, if in this question also we were preparing the consolidated statement of profit or loss, this one we said we added to the group cost of sales. But automatically this adjustment is not necessary simply because we are not preparing the consolidated statement of a profit or loss. So we will just add that, less that from the group PP, we less it from the retained earnings of who? Of Sheba. Of who? Sheba. So let's move to point number 2. In point number 2, we are told that on 28th April 2023, 28th April of 2023, this is basically some few days to the end of the year. So we are told Sheba Limited, which is this one, sent goods at an invoice price of 7 million to Pika Limited, which Pika Limited neither received nor recorded until 5th of May 2023. I hope you can be able to remember what is that. Automatically, that is now what we refer as the goods in transit. The goods in what? In transit. These are the goods which were sent by this company, but when the year was coming to an end, this company had not received nor recorded those goods. So we refer to them as goods in transit. The goods in transit. The goods in what? The goods in transit. Goods in transit, the GIT, the goods in what? In transit. Now, we said as far as these goods in transit are concerned, we make 3 adjustments. There are 3 adjustments which are made here. That is basically what you need to remember from our discussion. We said we make 3 adjustments. The first adjustment is basically to recognize the goods. To recognize what? The goods. That's the first thing you need to do. To recognize the goods. So these goods which were sent by this company, but when the year was coming to an end, this company had not received and accounted for them. So those particular goods, they had a value of 7 million. Even before we go to the last paragraph, to the next information which is given here, the goods had a value of 7,000,000. So how do we recognize these goods in the books of account of the parent? So if the parent company had received these goods, the parent company or these goods were supposed to be part of the inventory of the parent and part of the payables because the parent company had not paid for them. So therefore, these ones, we will add them to the group inventory. That is first adjustments. And then number two, we add them to the group payables. So those are the two adjustments which will be made to recognize those goods. So if this company had received those goods, they were supposed to be part of the inventory and still part of the payables. Part of the payables. So then the other adjustment which we need to make is the adjustment for unleased profit, because automatically this company made some profit, but automatically the entire profit was not yet realized. This company had not received those goods, so mean that the goods were not yet to be sold to the third parties. We make adjustment for unleased, we compute the unleased profit, and also these goods will give rise to amount of intercompany debt. But before we do that, we can go through the other information which are given in note number 2. Specifically the last sentence of paragraph 1, we are told 𝐻𝐶 Limited, which is basically the company which sold the goods, had marked up these goods at 25% on cost. And then you are told the last paragraph, the agreed trade payables record in the books of PICA, the agreed trade payables recorded in the books of PICA Limited before the above transaction of 6 million. Okay, so before we do that, let's first of all, we compute the unleased profit on these goods, unleased profit on the inventory. So the unleased profit on the inventory. So because we say that these goods were not yet received by this company, so mean that the profit which was made by 𝐻𝐶, this profit was not yet realized. So this unleased profit is by the selling company, which is 𝐻𝐶. So how do we compute this one? We said we take the goods in transit, we multiply that with the gross profit margin. So the goods in transit had a value of 7,000. That is the value of the goods in transit, this one, times the gross profit margin. Have we given the gross profit margin in that question? Have we given the gross profit margin? No. Whatever we are given is the gross profit markup. We are given gross profit markup as 25%. 25% as a fraction is 25% all over 100, which is basically a quarter. So if we have that as our markup, how do we compute the gross profit margin? We say this one will be equal to 1 all over 4, and then to this we add the numerator. So this one will be 1 all over 5. That is our margin. So our margin therefore here will be 1 all over 5. So give me the final figure here. The final figure here, which is 7,000 divided by 5. So that will give us an unleased profit of 1,400. So this unleased profit one will basically be deducted from the group inventory. And number 2, we also deduct this from the retained earnings of 𝐻𝐶. The retained earnings of 𝐻𝐶. So the other adjustments which we need to make as far as these goods are concerned is adjustment for amount of intercompany debt. Remember, this company sold some goods, sent them to the parent, but basically, because this company had not received those goods, automatically it had not paid for them. So that gives rise to amount of intercompany debt. So the amount of intercompany debt automatically will be equal to 7 million. But now there is also another information which is given in note number 2, the last sentence. Can we go to note number 2, the last paragraph? We are told the agreed trade payables recorded in the books of PICA before the above transaction was 6 million. What does that mean? It basically means that before this transaction here, before this transaction of the goods in transit, there was another amount of intercompany debt of how much? Of 6 million. So by the end of the day, the amount of intercompany debt between Sheba and PICA will be equal to the 6 million plus this other amount of 7 million. So the total amount of intercompany debt by the end of the day will be what? Will be 6 million plus now this one, 7 million. This is the total amount of intercompany debt. So this total amount of intercompany debt, this one, 13 million. This one, recall the adjustment. This one will be deducted from the group receivables and also from the group what? Payables. And remember, this amount of intercompany debt is the same. So it will be deducted from the group receivables and also deducted from the group what? From the group payables. The amount of 13 million. The amount of 13 million. So having said, we need to move to the other point. So therefore, if you come across that adjustment or that item, the goods in transit, you have to recall those 3 adjustments. Recognize the goods, compute the amount of the nearest profit, also they give rise to amount of intercompany debt. So number 3, we are told, a PICA limited policy is to measure the non-controlling interest at fair value on the date of acquisition. We said this information is to help you compute the goodwill. LCI is to be measured at fair value. When computing the goodwill on acquisition of the subsidiary, we use the full goodwill method. We are told for this purpose, the directors of PICA Limited consider Sheba Limited shares Sheba Limited share price of shillings 12 per share to be appropriate. In this case, we are not specifically given the NCI at fair value, but I'll be able to show you how we compute that specifically when answering part A of the question. So, but when computing the goodwill on acquisition of Sheba, we are going to use the full goodwill method. Then number 4, we are told impairment test performed on 30th of April 2024 at the end of the current year revealed that the goodwill on acquisition of Sheba Limited had not impaired. The goodwill on acquisition of Sheba had not impaired. We don't have any impairment loss. And then you are told, but due to the declining sales of Amua, which is the associate, the value of investment in Amua had been impaired to an extent of 2 million. So this is an impairment loss in relation to the investment made in Amua. So we are going to use that in answering part B. And then number 5, we are told Amua Limited reported profit after tax of 4 million during the current year. Also, that one will be used in answering part B. And then we are told number 6, assume all the profit and losses of the 3 companies accrued evenly throughout the year. So I think no workings which are required there. So what we need to do, we can go straight to answering part A of the question, basically whereby you are required to compute the goodwill on acquisition. The goodwill on acquisition of what? The goodwill on acquisition of Sheba Limited. Remember, in this case, I've said, as per the information which are given in note number 3, we are going to use the full goodwill method. We will use the full goodwill method because we are told the policy of the group is to measure NCI at fair value. We said if you come across that information, then compute the goodwill using the full goodwill method. So in this case, we need to have 2 columns. 2 columns here. So what do we start with here? We always start with the purchase consideration. The purchase consideration which was paid by the parent, company. And then to this, we will add the purchase consideration paid by the NCI. So the purchase consideration paid by the parent company, this information, we have it below paragraph 1. So let's go back to paragraph 1 of our question here. Paragraph 1. In paragraph 1, we are told PICA Limited, which is our parent, a public limited entity, intends to expand its operation by acquiring investment in other entities. In the last sentence, we are told, on 1st April 2022, Pika Limited acquired or secured 75% equity interest in Shiba under the following terms. We are given the terms of acquisition. We are told an immediate cash payment at a fair value of shillings 13 per share on 1st November 2022. So in this case, we are told when the parent company acquired 75% of Shiba, there was a cash consideration. The cash what? Consideration, that immediate cash payment. Immediate cash payment, if you can be able to recall, we refer to that as what? As cash payment. And in this case, we are told the amount which was paid here is 13 shillings per share. 13 shillings per share. Now, you may decide to compute this. So basically, to compute that, we should take 13 shillings. 13 shillings, you multiply that with the shares acquired in Shiba. The shares acquired. The shares which were acquired. But there is no need of computing this because this value is given in the statement of financial position of Pika. Can we go to the statement of financial position of Pika? Specifically where we have the non-current assets. In the statement of financial position of Pika, under the non-current assets, we have PP, property, plant, and equipment. And then from there, we have investment in Shiba. Investment in Shiba, you can see we are given 6 million shares at shilling 16, at shilling 13. So meaning that the shares which Pika Limited acquired in Shiba was 6 million. So 6 million times the amount which was to be paid per share, which will give us what? Which will give us 48 million. 48 what? Million. So, and why are we told that the shares acquired were 6 million? So we can first of all determine how many shares are issued by this company. The shares issued by Shiba, you get that from the balance sheet of Shiba at the equity. At the equity, the share capital of this is 80,000. So for us to be able to know the shares issued by Shiba, we will divide that with the par value. And I hope you can see the par value where we have the word ordinary shares in the balance sheet. The ordinary shares of this company, they have a par value of 10. So the shares issued by this company are 8,000. So the shares Pika Limited acquired in Shiba was 75%. So if you get 75% of this, that basically will give you 6,000. Alan, what are you referring to, 78 or 48? Okay, so the price is okay. This one should be 78, not 48. Yes, so that one is okay. It should be 78. Yes. So therefore, the cash consideration here is 78. 78. So 13 shillings times the shares acquired. Then I want us to go back to the information we have below paragraph 1, because other than this cash consideration, in point number 2, we are told there was an issue of 3 ordinary shares of shillings 10 per value in Pika Limited for every 5 shares which were acquired in Shiba. If you can be able to recall, we refer to that as the share exchange consideration. The share exchange consideration. So for the share exchange consideration, you need first of all to remember the formula. How do we compute the share exchange consideration? The share exchange consideration. In this case, we say compute the number of shares which were issued by the parent. Issued by who? The parent company. So this one we said the examiner will not give you this one, and then multiply these shares with their fair value or market price on the date of acquisition. So this is something we are already given. In that point. In that point, we are told the last sentence of that point 2, we are told the share issue. Okay, not that point, but point number 2. There is one somewhere we are told the fair value of Pika Limited shares was shillings 13 per share on the date of acquisition. So the shares of the parent company on the date of acquisition, they had a market price or a fair value of shillings 13. That one is already given. So what we need to do is to determine this. How many shares were issued by the parent company to pay the purchase consideration? We are going to use that information we have in point 2, where we are told an issue of 3 ordinary shares of shillings 10 in Pika. So Pika here was to issue, Pika Limited was to issue 3 shares for every 5 shares which were acquired, for every 5 shares which were acquired. So in our case, do we know how many shares were acquired by Pika in Shiba? Do we know how many shares Shiba Limited acquired in Pika? Sorry, how many shares Pika Limited acquired in Shiba? Do we know how many shares were acquired by our parent company, the subsidiary? Do we know how many shares were acquired by the parent company in the subsidiary? Do we know how many shares were acquired? Do we know how many shares were acquired? How many shares did the parent company acquire in the subsidiary? How many shares were acquired? How many shares did the parent company acquire in the subsidiary? How many shares were acquired? We have already dealt with that somewhere here. Just now. Yes, we have said the shares which were acquired were 6 million. We have computed that here. We have said that this one was also computed based on 6,000 shares which were acquired. The shares which were acquired were 6,000. So what we just need to do is to cross multiply, then we divide. So therefore, the shares which were issued here will be, because we need to cross multiply, then we divide 3 times 6,000 divided by 5. So this will give us 12, and basically that will give us what? That is 600. That is 600 shares. So these are the shares which were issued by the parent company. The parent company issued these shares. It issued, that is 600 shares, and then we need to multiply those shares with their fair value, which is shillings 13. So therefore, let's compute the share exchange consideration. That is 6 times 13. So I'm getting a figure of verse 40. 46,800. Are you getting that figure? 46,800. 46,800, yes. So now, this is the purchase consideration paid by the parent. Then to this we say, when using the full gooding method, we add something called the NCI at fair value. In other terms, if you can be able to recall, we said NCI at fair value. This refers to the purchase consideration paid by NCI. So when the minority shareholders acquired their shares, how much amount did they pay? Now, if we go back to the information we have in note number 3, we are not given this NCI at fair value. If you can remember the other question we did for Kuja 20, this value was given, the NCI at fair value. But if that NCI at fair value is not given, to compute that is quite simple, because we are saying when minority shareholders acquired their shares here, how much amount did they pay? So automatically you need to determine how many shares were acquired by the minority shareholders here. We know the parent company acquired 75% of the share. The remaining 25% of the shares are the ones which were acquired by who? The minority shareholders. The minority shareholders acquired the remaining 25% of the share. So therefore, we need to compute how many shares were acquired by the minority shareholders. 25% of the shares issued by this company. Hope you can remember, we have said that the shares issued by Shiba are 8,000. Its share capital divided by the par value. The shares issued by Shiba are 8,000. So these are the shares acquired by minority shareholders. So for us to be able to know the amount they paid for those shares, we have to multiply that with the market price of the shares on the date the shares were acquired. So automatically the shares were acquired on this date, the date of acquisition. Now, if you go back to point number 3, the last sentence, We are told for this purpose, the directors of Pika Limited considered Shiba Limited share price of shillings 12 per share to be appropriate. So it basically means that when the parent company acquired 75% of the shares, when the minority shareholders acquired 25% of the shares of these, each share had a market price of shillings what? Each share had a market price of shillings 12. So meaning that the amount of purchase consideration paid by minority shareholders was what? Was the shares they acquired, 25% of these times the market price per share. They paid shillings 12. They paid shillings what? 12. So therefore, in case you come across a question and you're not given the LCI fair value, what you do, compute the shares acquired by minority shareholders by LCI, multiply those shares with their market price on the date of acquisition. That will give you what? The purchase consideration, which was paid. So this will give us 0.25 times 8,000, which basically 2,000, 2,000 times 12, which will give us what? 24,000. Yes, so in this case, we need to add all this, which is the purchase consideration paid by the parent and who? NCI. So we have 78 plus 46.8 plus 24. And this will give us 148,800. So that is the purchase consideration paid by both the parent and also who? NCI. And then to this, we proceed with less the fair value of net assets acquired. Fair value of net assets acquired. Fair value of net assets acquired. This is basically something we said the examiner will not have given you. So, but is you have to compute this. We said in this case we need to determine at the date this company was acquired, what was the fair value of its net asset? And actually we said we compute that by adding its ordinary share capital plus the pre-acquisition reserves. Plus pre-acquisition reserves. So therefore what we need to do here is basically to take the ordinary share capital of this company, that is of Shiba. Where do we get that? We get that at the equity section in the balance sheet of Shiba. So the ordinary share capital of this company is what? From its statement of financial position, it is 80,000. So below that, we don't have anything else, but basically what we have is the retained profit. So retained profit, or basically the retained earnings, this one, we need to compute the retained earnings on the date of it was acquired. Now, if you check on this question, there is nowhere we are told we are given the retained earnings of this company on the date it was acquired. So generally, this is something you need to know moving forward. Anytime a subsidiary company was acquired during the current year, there is no single time the examiner will give you its retained earnings on the date of acquisition. But if you can remember the other question which we did for Kuja Trade, which was acquired, a subsidiary was acquired 5 years back, we were given its retained earnings on the date of acquisition. So, but a subsidiary acquired during the current year, the examiner will not give you its retained earnings. In very rare cases, the examiner will give you that. So you have to compute. Basically, what we know, I hope you can be able to remember that this subsidiary was acquired 6 months to the end of the year. That's what we said. It was acquired 6 months to the end of the year and automatically 6 months from the start. So what we do for us to be able to compute, because what you're interested with is the retained earnings of Shiba on this date. It was acquired 6 months from the start of the year, 6 months to the end of the year. So if you go back to the information we have in the balance sheet, when you go to the balance sheet of Shiba, specifically at the equity, you can see we are given the retained earnings of Shiba at the start of the year. That is on 1st May 2022. 1st May 2022 is at the start. We are given the retained earnings of that company at the start of the year. The retained earnings of Shiba. Remember, you're interested with Shiba at the start of the year, here, which was 12,800. That is the retained earnings of Shiba at the start. And then we also given the profit for this year, the retained profit for this year for Shiba, which is 10,800. So the reason why you're given that information is for you to be able to compute the retained earnings of Shiba on this date here, this date. How do we compute the retained earnings on the date of acquisition? Very, very simple. We take the retained earnings at the start of the year, this one, which is 12,800. And then to this, we add the profit, which was the retained profit for this period, for these 6 months, because we're interested with the retained earnings of Sheba on that date. So how do we get the retained earnings for the first 6 months? So we will take the retained profit for the whole year, which we also given as 10,800, and then we apportion this on time basis. We multiply that with 6 over 12, so that we know the retained earnings for the first 6 months. So once we take this plus the retained profit for 6 months, we will be able to get the retained earnings of Sheba on the date it was acquired, that date there. So this will give us 12,800 plus basically half of this, which is 5,400, and this will give us what? This will give us 18,200. 18,200. Are you getting 18,200? 18,200. Yes, that will give us 18,200. And basically, that is the retained earnings of Sheba on the date it was acquired. So therefore, anytime a subsidiary was acquired during the current year, the examiner will not give you its retained earnings on the date of acquisition. You must compute that. So that is basically the only reserve which we have within the balance sheet of Sheba. Then from there is something we said you must always remember to check whether the subsidiary company revalued assets on the date of acquisition. If yes, was there a revaluation gain? And I hope you can be able to remember on the date Sheba Limited was acquired, it revalued an item of asset, and there was a revaluation gain of 10,000, this one. So that one, we recognize it here. We recognize that there as a pre-acquisition what? Reserve. And basically in our case, we don't have anything else. So what we need to do is basically to get this total. To get this total, so let's add all those figures. We have 18,200 plus 10 plus 80. This will give us 108, 200, 108, 200, 108, 200. And in this case, remember, we're interested with the goodwill of the parent and the goodwill of the NCI. So what we do here, we take the net asset acquired by the parent and the NCI. The net asset acquired by the parent and the NCI should be 100% of this. So 100% of this is 108, 200, which basically will be less from the figure we have up here. We take 100% of that. So we less that from 148, 800. And this will give us a figure of 46 what? 600. 4600. So this is what? This is the goodwill on acquisition. The goodwill on acquisition. And remember, the information which are given in note number 4, we are told that this goodwill is not impaired. The goodwill has not lost any what? Any value. So that is basically the amount we are going to take to, we are going to recognize in the statement of financial position as a non-current asset. So this is what was required in part A of that question. And basically by doing this, the marks allocated here basically were 4 marks. So let's move to part B of that question. Part B. So in part B, what are we required to do? We are required to compute the value of investment in 𝐼𝐍 Limited. So this is part B, value of investment in 𝐼𝐍 Limited. In other terms, what we are required to compute here is something called the investment in associate. Remember, 𝐼𝐍 Limited is an associate. We are required to compute the investment in associate. So, and what you just need to recall is the format which I've just given you. How do we compute the investment in an associate? I've said we take the cost of investment, or the purchase consideration, and then to this we have said we add the group share of post-acquisition retained earnings, and any other reserve. And I think in this case, this associate, do not have any other stuff other than the retained earnings. And then to this we less what? Any impairment loss. Any impairment what? Loss. This one is quite simple because everything is provided here. I think we can start with the impairment loss, this one, which is given in note number 4. In note number 4. In note number 4, we are told that impairment test performed at the end of the year revealed that the goodwill on acquisition of Sheba was not impaired. This one had not impaired, but due to declining sales of Amua, the value of investment in Amua was impaired by 2 million. So we have an impairment loss here of 2 million, which basically we less here. So what about this one? So we know that this associate was acquired 6 months to the end of the year. So if we go to note number 5, we are told Amua Limited reported a profit after tax, which is the same with the retained profit of 4 million for the year. During the current year, this company reported a profit of 4 million. 4 million. And taking into account it was acquired 6 months to the end of the year, we want to know how much profit will the parent company be entitled to share. We will take the profit for the whole year, 4 million. But in our case, we're interested with the profit from the date Amua was acquired. Amua was acquired 6 months to the end of the year. So we compute the profit after Amua was acquired, and that is what we refer to the post-acquisition retained earnings, which will be 6 months to the end of the year. We multiply that with 6 over 12. We get the profit for the last 6 months, and then we get the parent company share of that. The parent company share of that will be equal to 30%. Will be equal to 30%. So let's work out that, which is basically quite simple. Half, which is 2,000, we multiply that times 0.3. And that will give us what? That will give us 600. That will give us 600. Then this one is given. This one is given. So we go to the balance sheet of the parent, the balance sheet of parent and the assets. How much amount did the parent company invested in Amua? So that is given in the balance sheet of PICA under the non-current assets. The amount invested in Amua is 24,000. 24,000. So you can see this one was quite simple because almost everything was given. So we compute now the investment in associate. 24 million plus 600 minus 2,000. So that will give us 22,600. I hope that is what you're getting. I hope that is what you're getting, yes. And basically by doing that, equally the marks allocated there are 4. So let's move to the last part of the question, whereby we are required to prepare the consolidated statement of financial position, basically for the year, which ended 30th of April 2023. 30th of April 2023. 30th of April 2023. 30th of April 2023. So Aaron, you're asking about what? How did you get 20,000 revaluation gain on part? Where do you have revaluation gain, Aaron? Do you have a revaluation gain somewhere of 20,000? I can't see that. I can't see any revaluation gain of 20,000. I can't see a revaluation gain of 20,000. So maybe retype your question again. Retype your question again of 10,000. This is what we dealt with here, Aaron. Take what we did in working one. Working one. And basically, can you try to see what we did in the other question? If you can be able to recall what we did in the other question, we are doing the same thing here. We are doing the same thing. So try to understand those concepts which are in all questions, especially this one. This one, you must understand this. This is in all questions for group account, fair value adjustment. So let's prepare this one. And basically, how do we prepare this? I want us to do this in the next 20 minutes. How do we prepare this one? We prepare this basically by combining similar items of assets and liabilities, those of the parent, those of the subsidiary. And that's why in this case, for example, you can see even the examiner has not given you the asset and liabilities of who? Of associate, because we don't consolidate an associate. What we include here as far as the associate is concerned is what we have computed here. Yes, so we only add assets and liabilities of the parent, those of the subsidiary. The other thing which is also important for you to note is that even if this subsidiary was acquired 6 months to the end of the year, we don't do what? We don't apportion assets and liabilities on time basis. So apportionment only applies to revenue and expenses. So we have to take the full amount of assets and liabilities of the subsidiary, even if it was acquired 6 months to the end of what? Of the year. So let's do that. So here, we will start with the non-current assets. So I will take the PPE and basically take the PPE of the parent, 135, plus the PPE of the subsidiary, 100, 400. And then to this, we need to check, do we have any adjustment affecting the PPE? Yes, this working one. Working one, this revaluation gain, we said we added to the PPE. And then number 2, we have this depreciation under charge of 500, which we said we less from the PPE. So 2 adjustments here. We add 10,000, the revaluation gain, and then we less what? We less 500. No any other adjustments. No any other adjustment. We get the final figure. We have 135 plus 100, 400 plus 10 minus 500. And I'm getting 244, 900. 244, 900. So below that, please confirm whether you're getting the same figure. So below that, we have investment in Sheba, investment in Amua. Do we include those items here? The purchase consideration paid in acquiring shares of Sheba and Amua? No. Instead, the investment in Sheba has been used in the computation of this goodwill. So what we include here in relation to Sheba is the goodwill on acquisition of Sheba Limited. How much is that? 4,600. That is basically what we include here. In relation to Amua, we include what we have computed here. The investment in Amua. The investment in Amua, what we have computed here, 22,600. That basically what we include here. And I think in our case, we are done with the non-current assets. So we need to proceed and basically record the current assets. So for the current asset, I will start with the inventory. So for the inventory, I will take for the 2 companies, I combine them, and then I make the necessary consolidation adjustment. 28,400 plus 12,100. And we said we have a number of adjustments affecting that. One, we have this goods in transit. Goods in transit. We said this 7,000 will be added to the group inventory. And then we have this unreleased profit over 14, which we said we also left from the group inventory. So 2 adjustments will be made here. So we add 7,000, the goods in transit, this one, and then we do what? We left this unreleased profit of 14. We left that unreleased profit, we get the final figure, So we have 28,400 plus 12,100 plus 7 minus 14. So which will give us 46,100. Okay. So below that we have we have the trade receivables. We have the trade receivables. The trade receivables, I'll do the same. I'll take the trade receivables of the 2 companies, I combine them, 27,500 plus 19,900. And then I check, do we have any adjustment here? Yes. We have this adjustment for amount of intercompany debt, 13, which will be deducted from this group receivables. I only have this adjustment here. That no any other adjustments. So we get the final figure, 27,500 plus 19,900 minus 13. So which will give us 34,400. So then finally we have the cash and cash equivalents. So we add for those two, for the two companies, that is basically 10,600 plus 68 plus 68. Do we have any adjustment affecting this? No, because we don't have any cash in transit. We just need to get the total. We just need to get the total. So that will give us 17,400. 17,400. And then what do we need to do? We need to get the total assets. So the total assets, we add all this. We have 17,400 plus 34,400 plus 46,100 plus 22,600 plus 46 plus 244.9. So in this case, I'm getting 406. I'm getting 406, 406, 406, 406,000, 46,000, 46,000. I don't know whether you're getting the same. So I can do away with this to create space here. Yes, someone to confirm whether you're getting the same. Yes, that is confirmed by Juliet. Okay, so then from there we proceed and record equity. So that is share capital and reserves. So at the equity, we will start with the ordinary share capital. Ordinary share capital. In this case, we said for the ordinary share capital, we record that of the parent company only. The ordinary share capital of the parent, in this case, will be 160,000. But in this question, the ordinary share capital of the parent will be having an adjustment. We said whenever the parent company has paid some purchase consideration by issuing shares, those shares which were issued by the parent company, they were not accounted for. And basically, we said the shares issued will affect the ordinary share capital and the share premium. So, and how many shares were issued by the parent company, the payment of purchase consideration? We computed those shares. In our computation of the purchase consideration, did we say the parent company issued, were they that 600? Because the parent company was to issue 3 shares for every 5 shares acquired. The shares acquired was 6,000. I think we multiplied this. So this was the 3 times 6,000 divided by 5. And I think this was coming to 36. Yes. The shares issued by the parent were 36. Now, what do we add here to the share capital? The amount we add to the share capital is an amount equal to the par value. So the par value of these shares, would be 36 times the par value per share, which is 10, So that will increase this. So this will be 36,000 times this, which will give us 196. And when the parent company issued these shares, what was the market price per share? Ile market price tumetumia ku compute purchase consideration. Was it, it was 13, Was it 13 shillings? 13. So the amount which is above 10, and basically that is 3 shillings, that is a share premium. So belonging to the parent. So in relation to these shares which were issued by the parent, tutakuwa na share premium ya 36 times what? Times 3 shillings. Times 3 shillings. Times 3 shillings. That will give us what? That will give us what? That will give us then 800. That will give us then what? 10,800 is the share premium of the parent. Yes. So then from there, there is something we said which must be computed here, which we said this is one of the items which is quite demanding, and that is the retained earnings. And I think moving forward, there are those items. In fact, because we said even in an exam setup, these are items you don't need to compute. Like this one, the retained earnings, because we said by doing this, it's not a must you have to get everything correct. Sasa, Yes. So maybe first of all, you can skip this. If you're going to have some time, we will compute. But this is an item I'll not advise you, even in an exam, never bother yourself computing this. The other item we also need to compute and we include here is basically something called the non-controlling interest. Also, we will compute that if time will allow. But let's first of all, we proceed and record the liabilities. We will be able to compute that. So these are two items which are quite demanding. So the non-current liabilities, I will start with there are actually two. We have 10% bank loan, 10% bank loan. No adjustment for this. We just add that of the parent and that of the subsidiary. This will give us 35,000. No adjustments there. Below that, we have deferred tax. We said anytime you come across a component for tax, also this is a free mark. No adjustment. We just add 37 plus what? Plus 31, which will give us 60, 68. No adjustments here. Then we go to the current liabilities. For the current liabilities, we will start with the trade payables. Trade payables, we add that of the parent, 28,800, plus that of the subsidiary, which is 21,200. And then now to this, we have, I think, two adjustments affecting the payables. One, we have these goods in transit. This amount of 7,000, we said we added to the payables. So to the payables, we add 7,000. And then I hope you can also be able to recall we have this amount of intercompany debt, 13. So to be deducted from payables. So be also less 13,000. So those are the only the two items to be adjusted to the payables, So let's get the final figure here, which is 28,800 plus 21,200 plus 7,000 minus 13. So I'm getting 44,000. 44,000 like that. 44,000 like that. And then finally, I have current tax. Current tax, we said, being a component of tax, this is also another free mark. So you have 19 plus what? Plus 13. Plus 13. This is also a free mark. And basically, this will give us what? This will give us 32. This will give us what? 32. This will give us 32. Then we will get the total equity and what? The total equity and liabilities. The total equity and what? And liabilities. The total equity and liabilities. Do we need to compute these two items or we can just leave them? Do we need to compute them or we can just leave them? Because like this question, by doing that, we'll be able to get all the marks, even without necessarily coming back to compute these two items. I hope you can be able to recall the other question which we did, the computation of these two items. We said we were able to see that it is basically quite demanding. But basically, once we're able to do this, you'll be